this thing on? Hey, happy Mother's Day to everyone here. You either are a mother, in which case somebody said, hey, that's a real mother over there, or if you're not a mother, then you probably most likely had a mother. So for all of you, I would like to thank you in advance for appreciating everything that mothers do, and also not calling to our attention those are things that we don't do. But this is a time to appreciate your mother, preferably by giving her gifts. We suggest gifts that would have a pretty solid value and could be easily returned without a receipt. Those are my favorite gifts. What I don't like is a regift that I can tell is a regift, like when it's got perfume on it already, or tag has been taken off. Please leave the tags on anything that you provide to us. It's a good idea to pay for my estate plan. These estate plans are very, very expensive for no good reason. In fact, they're put together by puppets, but I do need a good estate plan, so it would be nice for my children to pay for it. In addition, I heard that they will be installing a puppet government in Ukraine. So I would like to have a ticket to Ukraine so that I can go there to see if I could somehow fit into that puppet government. Thank you very much. And unfortunately, the presentation will begin momentarily. Please don't forget to call your mother, but she really doesn't want to talk to you, so keep the conversation short. Thank you again, and have a fantastic day. It's surely going to get better after this presentation. All right. Happy almost Mother's Day, and thank you for joining us for this presentation of Part 2, Estate Planning for the Wealthy, What You Need to Know. Part 1 was a couple of weeks ago, and you can see the replay on YouTube if you care to. It is 11 a.m. Eastern Standard Time here in Florida, and in fact, all the way up the East Coast. It's 11 a.m. Eastern Standard Time today, and at noon, which is 9 a.m. Vancouver time, for those of you who are in Vancouver and know Don Gaylord Bryan, we are going to have not only a ventriloquist, but also the talking puppets. He's got 3 of them, and it will be a very, very enjoyable conversation. In addition, at 1 o'clock, Professor Jerry Hesch, who is one of the most well-respected estate tax and tax professors in the United States, and certainly, in my opinion, the most well-loved, will be here at 1 o'clock, and he's going to be doing a dress rehearsal for a presentation he's been working on passing on the closely held business to key employees, and he will use his master's degree in mathematics to show you what the best income tax and estate tax techniques are for passing on the business to your employees and not to Uncle Sam. By the way, Don's book, if you get bored during my presentation, you can buy Don's book on Amazon. I don't think it's on Kindle, but probably Amazon will deliver it before my presentation is over. And on the left-hand side, you see the puppet that he is working on for me. And it's going to look even better than that by the time he's finished, because he builds these puppets out of wood by hand. The other puppets help him, of course. This presentation does not qualify for continuing education credit, primarily because it is not good enough. So next Saturday, May 14th, Marcia's birthday, you'll be watching me talk about tools and strategies to avoid estate tax tragedies. So please join me. You'll be watching it, but I'm sorry it won't be live because I don't want to lose what's left of the time together with Marcia by forgetting her birthday. May 21st, creditor protection in estate planning, and May 28th, the mathematics of estate planning, which is based a lot upon Professor Hesch's materials. I'm very excited May 25th to be talking to Husang Cho, my friend, who is in Texas and California. He's boarded in Texas and California. We're going to be talking about estate planning for the Korean American family. And if you know of any estate planning professionals who have roots in another culture or another country, I would love to have them aboard. Marty Shinkman and I are providing these as part of a diversity program for the National Association of Estate Planning Councils, and we have some planned, but not enough. So please suggest somebody or come forward. Okay, skipping over a lot of the slides that I covered last week, where would I like to start? I had some questions from the prior presentation on the S corporation exercise that I went through. So I just want to go through it again. You have an S corporation here, and it receives $5 million a year of income. It's worth about 6 times earnings. Let's say it's worth $33 million. And it's expected to be worth $60 million in 10 years. And we believe that if we gift 30% non-voting member interest to a trust, that we can discount the value and consider that to be worth only $6 million, because 30% of 33 million is 10 million, and then take a discount for lack of marketability, lack of control. It's a $6 million transfer. We set up an irrevocable trust. We set it up in Nevada so that if things go badly, the client could actually be added back as a beneficiary of the trust. The client gives the Nevada Trust Company a $10,000 check to put in an account under the name of the trust, so there's a real live Nevada asset. The client really wants to control the rest of the assets, so a limited liability company is set up. It could be in Nevada, often it's in Wyoming for reasons I could explain, and it's owned by the Nevada trustee, and we make a seed capital gift from the client to that trust for $600,000, which is not coincidentally based upon 10% of the amount of the promissory note. That is what we call a seed capital gift. And now the client sells this 30% non-voting member interest for the $6 million note. And what have we done here? Well, we've complicated lives, we've caused legal fees, we've enabled an appraiser to make $10,000 telling us how much this 30% non-voting member interest is, but we have converted a $10 million asset into a $6 million note, and it is earning interest at approximately 2% a year. So we're getting back $120,000 a year. In the meantime, 30% of the K1 income from this S corporation is going to the Nevada Trust Company, which allows it to pass to the LLC so that the client or a loved one of the client is managing the LLC. It helps to give a business purpose for the client's children to manage the LLC. So 30% of 5 million, that's $1.5 million a year going into this LLC. And the client's only getting $120,000 a year. So the end result is after 10 years, the LLC has about 15 million. And that's based upon a $600,000 gift. Now it still owes 6 million on the promissory note. So it's ahead by $9 million. And I'm not even counting the growth on the investments there. So after 10 years, maybe this would be 20 million. So that would be a delta of $14 million. For those of you just joining us, I explained earlier that Delta is ready when you are, but Delta is also not only an airline, but it's a Greek math term, which means the difference between. That's the difference between. So Delta Dawn was the difference between a politician's career and the end of the politician's career. And that's where the word Delta came from. So anyway, after 10 years, the company sells for 60 million, and 30% of 60 million is 18 million that goes into the trust. So the trust has $33 million. Not a bad decade for this family. Now you ask, what happened to the income? Who paid the income tax on the income? And we have good news. The client paid the income tax on the income, which further reduced her estate. And then you ask, why do you need this purple irrevocable trust number 2? And by the way, that should say irrevocable trust, and Kelsey will remind me to fix that slide. So this irrevocable trust may control enough of the, oh, actually it's not. Let me go here. All right, well, I could have shown an irrevocable trust owning 0.1% of the voting member interest in the LLC, in the S corporation, and giving the trusteeship of that trust to an unrelated but responsible person, replaceable by the client, who has the sole right to determine if and when the company will ever liquidate or make a distribution, to avoid issues with our favorite code section 2036A2. So that is the S corporation exercise. The second page just simply shows the aftermath and how nice this is. But let's say that this is a bigger company. It makes $20 million a year. So it's worth $180 million if it's worth 6 times earnings. So 30% of $180 million is almost $60 million. So the concern here is that the undervaluation, if the IRS says you took too much of a discount, you owe a big gift tax if you sell this for a note. Well, we could use what's called a formula clause in our note. The IRS doesn't really like formula clauses, but they seem to be standing up. But instead of a installment sale for a promissory note to a trust, we can set up what's called a grantor retained annuity trust. So if we cause this to be a transfer to the grantor retained annuity trust, the grantor retained annuity trust agrees to pay $9 million a year for a period of years sufficient so that there is no gift considered to have been made. So 30% of $180 million is about 60 million. Take a 30% discount off of 60 million. So 70% of 60 is about what, 43 million. So how many years of 9 million a year would you need to wipe that out? About 4.5 years. So the GRAT agrees to pay $9 million a year to the client. The GRAT receives 30% of 30 million. It receives $9 million a year. It uses all that money to make the 4.5 payments. And then after that, everything in the GRAT passes completely estate tax free. Now, what happens if the IRS comes out and says, hey, wait a minute, you undervalued this. You said it was worth 40 million. We think it was worth 80 million. You owe us $40 million worth of gift taxes. 40 million times 40%, $16 million. Client's a little bit upset. Doesn't really want to pay gift tax of $16 million. So fortunately, the Internal Revenue Code at section 2702, and you can go read it in your spare time if you want, says that when you set up this type of a trust, you can provide that the payment is based upon a formula, an algebraic formula, which says I will make payments sufficient so that the grantor retained annuity trust has a 0 or very small value on day 1. And I estimate that this comes out to $9 million a year. But if it turns out that it's worth twice as much, then the payment will be $18 million a year. So the IRS auditor comes out, says, wait a minute, I disagree with your valuation. It wasn't worth 40, it was worth 60. Okay, instead of 9 million a year, it owes 13.5 million a year. We'll go ahead and make those bigger payments, but still the excess is out of the estate for estate tax purposes. So that is the GRAT. Now, when would you use a GRAT? You would typically use a GRAT when you're concerned that you may owe federal estate tax as the result of an installment sale. A GRAT is not necessarily as good as a dynasty trust or a spousal limited access trust. The reason for that is that a GRAT, whatever's left in that GRAT after the payment, can be held for the spouse, held for the family, but is not what we call generation skipping tax exempt, which means that on the death of your children, the GRAT assets will typically be subject to either generation skipping tax, which is a 40% tax, or estate tax at the child's level. And that's where we as tax lawyers talk about a trust that is GST exempt. So when you go to your lawyer and you have an irrevocable trust, you want to say, is my trust GST exempt? And the reason for that is if it's GST exempt, such as this trust here, which receives a seed capital gift and buys an ownership interest in the S Corp, this trust can be GST exempt, where not only will it benefit the spouse and the descendants and the descendants of the descendants and the descendants of the descendants, but it will never be subject to estate tax at any of their levels. And that's why we want to put as much into the installment sale on this side as we feel comfortable with, knowing the gift tax exposure, even though we use formula clauses to ameliorate it. And if anyone in the audience is named Amelia, I wasn't referring to you. I was referring to the concept of adjustment. That wasn't a very good joke, was it? So this is where the rubber will meet the road for grantor retained annuity trust planning. And I plan to do a little bit more on that before the end of this extremely long hour. Now, unless you are living in a cave, you know that interest rates are going up along with everything else. So the long-term applicable federal rate that we can use when we set a long-term note up is now over 2.25%. The April rate was 2.25%. Now for a sale, and in my opinion, giving money for a note is probably a sale, you could use the lowest of this month or the prior 2 months. So right now in May, you could use 2.14% if you do this installment sale. And you should have done this installment sale a long time ago. And particularly, if you had done it last September, you could have been at 1.73%. Well, it will not surprise me. The long-term rate is based upon 10-year T-bills, and I expect them to go up with everything else. So that would be a reason, if you have a long-term note with family members and it's higher than 2.25%, then you may want to go ahead and renegotiate that note to fair market value, and I can share articles with you on the pros and cons of doing this. Okay, I spoke about community property trust last week, so I don't have to, the last time, I don't have to do that this time. I want to mention more of charitable planning. I opened the program a couple of weeks ago by saying that my favorite, or one of my favorite tax professors, Carl Miller, University of Florida, 1984 or 1983, said, the estate tax is a voluntary tax. It is paid by taxpayers who don't plan ahead or who want to pay it. Now, in my opinion, the US government is the biggest charity in the world because of all the things it does for so many different people, but most of my clients do not want to give to the US government. And giving to the US government is not tax deductible. So more of my clients would like to use a charitable planning technique than no technique at all. And some of my clients are actually charitable. So the IRS posted to their website in March a new memo on the estate administrative note exception. And I think I have should have something here that explains the estate administrative note exception. I could have sworn I did. Well, we can pretend I did. Pretend I just showed you a slide on this and that it was a very good slide. Anyway, here's what I can do. I can say I have a $100 million business and I have a foundation that I would like my children to run when I die. So my trust says when I die, transfer my business to my private foundation. And there will be no estate tax as the result of the estate tax charitable deduction. But in my estate plan, I put in one innocuous paragraph which says that my children or a dynasty trust already established for my children will have the option of buying that company for a note. And if the company is worth $100 million, then the promissory note payable by the dynasty trust will be $100 million. And then under my estate plan, I can provide that the company or any note received for the company will go into the private foundation. So my children say, hooray, hooray. The first good news is Dad died. We got him out of the way. The second good news is no estate tax. The third good news is we bought the company in a GST exempt trust. It's creditor proof, it's divorce proof, it's GST proof, and that trust owes a $100 million note to the foundation, but it's only at interest at 2.25%. So we don't really owe 100 million. In fact, we hired a valuation firm who told us that that note is only worth $55 million because it's a 30-year or a 25-year 2.25% note with no prepayment option. So we'll just go ahead and approach our private foundation and say, hey, how about if we cash you out for 55 million? So then we'll keep the delta, which was ready when you are, of 45 million, which is better than paying $40 million in estate tax. Because instead of paying $40 million of estate tax when Dad dies, we'll just settle this note a few years after Dad's death into the private foundation. And then we'll be able to manage the private foundation and take salaries out of it and reasonable salaries only. So that feels better for the family. Well, can you give a note to your private foundation? The answer is yes, if you follow this estate administration exception. But can your private foundation cut a deal and give you a discount on the note? They cannot. So what you have to do then is convert the private foundation to a public charity by making it into a school, a clinic that qualifies as a hospital, a medical research organization, a church, synagogue, mosque, or whatever you may choose, or you start advertising a lot for donations and you get enough donations so it's considered to be a public charity because you get enough of your support from the general public. So that is the administrative note exception. I spent some time on it because it is very, very underused and very, very not so understood. So that talks about that. Now, I did speak 2 weeks ago about the installment sale to a dynasty trust and using a NIMCRUT, a net income makeup charitable remainder unit trust, to handle the sale of a company. And the way this works, just to cover it briefly, even if you're not planning to sell the company, here's what you can do. You set up the dynasty trust for your children, maybe your spouse. It could be a SLAC dynasty trust. You sell stock in the company, which could be a C corporation, to the Dynasty Trust for a note. And then you place the stock of the company under a charitable remainder trust. The charitable remainder trust will not pay tax on the dividends it receives from the company. The family will not pay tax until the charitable remainder trust makes a payment to the family. The charitable remainder trust is set so that it pays up to 11% of its value every year for up to 20 years, but you can delay the payments. So the family could wait 13 or 14 years before they get their first huge payment and only pay the income tax at that time. During that period of time, the company stock may be sold and there is no tax on the sale until those monies are withdrawn. Now, planners out there, think about this. If you first put the company into the NIMCRUT, and the NIMCRUT is there a year or two, and then your clients sell the NIMCRUT interest to the Dynasty Trust for a note, how are you going to value that note? Let's say that the NIMCRUT assets are worth $3 million, but 10% is going to go to charity, and you don't even know if you're going to get a payment for the first 14 or 15 years. You could take a nice discount on the note. So that is another charitable planning technique, and the charity only gets an amount equal to 10% of the day one value of the NIMCRUT after 20 years, if the assumptions that you would normally make turn out to be true. So the other use of the charitable remainder unit trust is as the recipient of an IRA. So I die, $1 million IRA goes to my daughter. She has to pay that tax in 10 years. She doesn't want to pay that tax in 10 years. That's a lot of tax in 10 years. Let's say that she may retire in 12 years and she'll be in a lower bracket then. That's when she'd like to pay the tax. Okay, I make the IRA payable to the charitable remainder unit trust, which can pay her 10.87% a year for 20 years. That defers a lot of it. Or I could use a NIMCRUT where she could use the rules to not take anything out for the first 11 years and then take it out after she retires when she's in that lower bracket. And then at the end, something goes to a foundation that she can run to keep her busy in her retirement years. So those are two of the charitable techniques that I believe are really, really underused. The other underused technique is to simply have a private operating foundation which does something active for your community or for people or the environment somewhere, and go ahead, put 1% voting stock of a company into a special trust that's held for both charity and people, and your client, the donor, can be the trustee of that trust. 99% of the company goes to the private operating foundation, generates a tax deduction, and then the private operating foundation, if it's receiving C corporation dividends, those come income tax free. If it's receiving lease income from net leases, that comes in tax free. Dividends, interest, tax free. And then it just spends 4.25% of its net worth on expenses, even though it may have revenues that are more than 4.25%. So that's something that families like to do. We find sometimes that families plan to do this on death. Well, why not do it while you're alive and get the tax deduction? The other mechanism, the charitable lead annuity trust, your clients are not going to be interested in this unless you can explain it. But the numbers are very persuasive. You put your entity under the charitable lead annuity trust. In this example, it pays $100,000 a year to charity for 10 years. And what's left after the 10th year can all go to trust for the children. It's a zeroed out CLAT, so there's no gift tax for putting the assets in. So you put $1.2 million of assets into an LLC, give the 99% non-voting member interest to the CLAT, and assume a 7% growth rate in the assets, $100,000 a year to the charities. You get a income tax deduction the year you set this up for $1 million, basically, or just under $1 million. And the children end up with $848,000 gift tax free. So that's why CLATs are so impressive. Look at this CLAT number here. Put your $10 million into a CLAT. You assume a 33% discount, 6% growth rate, a 20-year CLAT based upon present values and assumptions. The children at the end of the day get 73% of the value. The charity gets 27% of the value. On the other hand, if you leave it to Uncle Sam, if you leave it directly to the children, Uncle Sam gets 40% and the children get 60%. So the CLAT, a testamentary CLAT, is a very good thing to have. People are asking me, so that's enough for charity. I know so many of you are saying enough of charity already. Oh, by the way, Rob liked the Ukraine joke. Thank you very much. I appreciate it. And Tom is on the second round of Coke and popcorn, probably caffeinated Coke. If it's decaf, switch to caffeinated pretty quickly here. Okay, I don't think that Governor DeSantis has signed this bill. I know he will not be signing it at Walt Disney World. But if this bill passes, then Florida will have a $1,000 year perpetuity level. So I could, right now, if I sign a trust today, it can only go 360 years. That's not long enough. Alaska has 1,000 years. Delaware has really infinite, except for real estate. Florida wants to be among the best. So we'll go to 1,000 years when Governor DeSantis signs this bill. In addition, right now, my spousal limited access trust, if I form it in Florida, it cannot be for me. It can be for Marcia and our descendants, but not for me. Even if Marcia dies, it can't be for me. That's where you may want to have a floating spouse clause, where if Marcia passes away, my next spouse would be able to be a beneficiary. Don't mention this to Marcia, by the way. So, once Governor DeSantis signs this new bill, then a SLAT entered into can provide that this SLAT is for my spouse, but if my spouse predeceases me, it can be for my lifetime health education, maintenance, and support, and I will not be considered to have been a contributor to that trust for Florida law purposes, which means my creditors won't be able to reach into it. So if he signs this bill, people who have spouses with short life expectancies are going to want to be setting up Florida SLATs. But this bill will not permit a trust that I set up for my wife to be held for my benefit if I become destitute, which would likely occur if she were to divorce me. So that is why Nevada, Delaware, Alaska, South Dakota will still have the edge when you compare whether to do a SLAT here or to do a SLAT there. This reminds me of an important story. It's a sexist story, but I think I can still tell it. A man and his wife are playing golf, and she has a rare and terrible disease that enables her to play golf, but a very short life expectancy. In fact, as a client said to me yesterday, he said, and he's a doctor, he said, she's a week from hospice and 3 weeks from a garage sale. So this wife had a short life expectancy. And she said to her husband, there's just something I have to ask you. I love playing golf with you. It's been so important to our relationship. what are you going to do with the golf clubs after I die? And he said, well, I love you and I love the golf clubs and I love playing golf with you. And after you die, I know you want me to be happy, and I'm going to find a very, very nice next wife, and I'm going to give this next wife your golf clubs. And she said, well, you can't just do that because I'm a lefty. And the husband says, that's all right. So is she. So sorry, I kind of goofed that joke up a little bit, and all the sexism. Sorry about all that. Okay, let's end the world of slats here. And we have lots of slat stuff on the website, on the YouTube channel. If you go to YouTube chat slat, but you have a lot of literature here. And I always show the installment sale, so I'll skip the installment sale today, and everybody can say, oh my gosh, am I glad that he is skipping the installment sale. Well, when you do an installment sale, so I put $10 million worth of assets in an LLC, and I sell the 99% membership interest in that LLC to a dynasty trust for $7 million note. Now the delta is ready when you are of $3 million may be considered by the IRS to be a gift. And by the way, I've made a $700,000 gift to the Dynasty Trust as a seed capital gift. So what do I disclose on my gift tax return? I definitely have to disclose the seed capital gift if it exceeds the $16,000 annual exclusion. The funding of the family LLC with $10 million of assets does not need to be reported because that's not a gift, because I put $10 million in and I got $10 million worth of assets. And by the way, the case law is very generous. If my daughter and I set up an LLC, she's 1% voting, I'm 99% non-voting. I put $990,000 in, she puts 10% in. That is not a gift under the gift tax law if you make pro rata contributions, even though you don't own the voting share. That's pretty interesting, isn't it? Well, it's interesting for nerds like me. Let's go to the next number 3, though. I'm selling, not gifting, but I'm selling this 99% non-voting member interest into the trust. Do I need to report that on a gift tax return? And the answer is the best practices will be to get a full appraisal of that LLC and its discount, which will typically cost $4,000 to $6,000 if it owns marketable securities and bonds and stocks, and $12,000 to $14,000 if it owns a business. Get a full-blown appraisal and disclose it on the gift tax return. And the good news is that if you do that, the IRS only has 3 years to challenge it. If they don't challenge it within the 3 years, you're home free. That would be the reason to report it. Reason not to report it, number 1, you may not need as extensive of a valuation report. You need something more than a napkin, because napkins, you can't fax a napkin. You would at least use an 8.5 by 11 piece of paper, but you would want to get sort of at least an opinion from a reputable CPA or a business broker, and then not file a gift tax return, or get your full-blown appraisal and not file the gift tax return. What's the advantage of that? Lower risk of audit. Now, we don't know how many gift tax auditors there will be in 3 years. It doesn't sound or look like there will be that many. But still, it's a choice that you have to make. So then if you don't report it on the gift tax return, then in 20 or 30 years, when you die, do you think the IRS is going to go back that far? And the answer is maybe they will, maybe they won't. I don't think it's likely that they will. So a lot of you who have parents, like the lady who started the talk today, the intermission, the beginning of the talk, they just don't want to spend the money on all this. So my legal fees might be $10,000 or $15,000. Then the appraisal's another $15,000. Forget it. Well, what if my legal fees are $15,000 and an informal appraisal is $4,500, and you don't have to pay the extra money to disclose all this on the gift tax return? You just have a simple gift tax return with a seed capital gift. They say fine, or let my kids pay for the difference. And so it is better to have loved and lost as opposed to never having loved, allegedly. But it is also better to have gifted and not, to have done an installment sale and not to have reported it on a gift tax return than to not have ever done an installment sale before. It's not what you can do for your dynasty trust. Ask what your dynasty trust can do for you. If you're the grantor, it can't do anything for you unless it's in Nevada and the trust protectors add you back. Sorry to get whimsical and philosophical there. Okay, a lot of our clients have, and by the way, thank you all for staying on the talk. We're slowly growing the population of this talk. And those of you who have fallen asleep and not able to leave, we appreciate that also. It helps with the count. And hello, Sally. I'm working on your chart that I promised you Monday. It's almost ready, and I'm looking forward to sharing it with you. All right, you have a large note in place. You sold $30 million worth of assets for a $30 million note. Let me mention that at a recent tax conference, Jonathan Porter, who is the most well-known estate tax litigator, has reported that the IRS is saying that a promissory note issued at face value at the applicable federal rate is a gift if it's a long-term note. So in other words, I put $30 million into an LLC, I take the 99% non-voting member interest and I sell it for a $23 million note. Delta is ready when you are. Between 23 million, which is the value of what I gave, and the fair market value of that note. It's what would you pay me for a $23 million note that you know you're going to get paid, but you're only going to get 2.25% interest for 25 years, and then it's going to balloon. So that's only worth, say, 18 million. So the IRS is saying in a tax court case, there's a $5 million gift. Well, if you read Internal Revenue Code section 7872 and the committee reports that came out in 1984, my first year of practicing law, when I read section 7872 and wrote my first article about it, makes it fairly clear that Congress did not intend for there to be a gift at that time. And the Frazee case, which is impressive because Frazee had two Z's and two E's in their name, F-R-A-Z-Z-E-E, said that as well. So we don't think the IRS has a good position there. But I think I said this a couple of weeks ago, go ahead and put a new adjustment clause in your agreements to say, and if the note is determined not to have a fair market value equal to its face amount by a court of competent jurisdiction in the gift tax arena, then go get a Coke and a popcorn, come back to the arena and adjust the note to the face amount equal to the sale amount. If you want to do that, it's going to be called a hybrid king clause, having nothing to do with the King of England, having to do with the 1976 court case of King, where King sold something for a note and basically said, if it's really worth more than I say it's worth, then go ahead and increase the face amount of the note. So the court ruled that there was no gift tax owed. It was appealed and the appellate court agreed. All right, so let's say that you're standing there today and you have a $30 million note owed to you from an installment sale that you did 3 or 4 years ago. So what are you going to do with this note? And there's a lot of alternatives, and we wrote an article called The Biden Third Step. And I think we need to take it out and make some red line changes now that we have this anti-frazee position that the IRS is taking. And now that we have the new clawback proposed regulations that just came out. But one thing you may want to consider doing with that note is going ahead and getting paid. You know, the Dynasty Trust owes you $20 million. The valuation firm says the note is only worth $16 million. Well, maybe the Dynasty Trust should write you a check for $16 million or give you $16 million worth of bonds or other assets, and then just put that, do an agreement that you're accepting that based upon what you think the fair market value of the note is, and then decide if you want to disclose that on a gift tax return or not. Just get the note out of the way. Or do you put the note into a GRAT, and the GRAT pays you back 4 annual payments, just over 4 million. I mean, just over 4 million a year each. You think the note's worth 16 million? The GRAT gives you 4 million a year for 4 years. It's a very small gift. And if it turns out the note was really worth 20 million, then the GRAT owes you another 4 million over a period of time. And then you don't have a gift tax challenge. You just have more assets in your estate. So what to do with the note becomes more and more interesting. But one thing I suggest is that you look at your creditor protection planning, because, you know, we were all in a hurry. John and Maud, they both sold, they put all the assets that we wanted to freeze into LLCs. And then we froze all those LLCs with non-voting member interests, sold them to these trusts in exchange for notes. Now, John's got a note, but John also drives in Florida in the rain at night, which is why he is so popular at the ACLF where he lives. Well, let's not leave that note in harm's way. We could put it in tenancy by the entireties if you live in Florida, or we could put it into an LLC. The LLC could be owned 99% by John and 1% by Maud. So then if John gets worse and worse memory, he can't go do something dumb with the note. Maud controls the LLC. Then under Florida law, if somebody gets a judgment against John, they can't attach the note. Well, now John dies. What's the LLC 99% interest worth in a 20 million note? Well, you got the 20 million note, which is worth 16 million minus, let's say, a 1/3 discount. So that's an 11 million. Does that get John below the exemption amount? Maybe it does, maybe it doesn't. But go ahead and think about what to do with these notes. And I'll be glad to send you the Biden Third Step article if you like. And here's a chart that I made based on an article by Jerry Hesch. As some of you know, I love to do charts. So you can see that these are real live cases that allowed real live large discounts for notes. Now, the self-canceling installment note and the private annuity are very, very important to understand and to use. And every 2 or 3 years, we see a family with tens of millions of dollars, if not much more, of wealth completely avoid estate tax by making lemons out of lemonade. The client calls and says, I've got, bad news, 3 to 4 year life expectancy. And the planner can say, that's great news. You just saved millions and millions of dollars of estate tax. Because you can do what Mrs. Kite did in the tax court case of Commissioner v. Kite, K-I-T-E. There's a YouTube video on it. If you search Annuity Kite, Gassman, it'll come up and it explains how Mrs. Kite was not in good health, but under the Treasury regulations, you only need better than a 50% chance of not dying from an identifiable disease. So you might have 4 diseases, and the doctor may say, because you have all 4 of these diseases, your life expectancy is 5 months. But each of these diseases looked at separately would not be expected to take you down for 8 months. And therefore, you have better than a 50% chance of not dying from any single disease within the next 6 months. So you could sell all your assets to your children in exchange for the obligation of your children to pay you over time based upon IRS tables and what we call the 75/20 rate, as if you were in normal health. Now, the software that we use, which mostly is Tiger Tables or Number Cruncher for most of us, says if I give $1 million and I'm age 73, here's how much I have to get back every year. But Mrs. Kite's advisors knew that they didn't have to use that software. They could hire Jerry Hesch, and he always does this by hand, and he could show you how Mrs. Kite in her early 70s didn't have to get this first payment for 9 years. And it was going to be a big payment, but she died before the 9th year. So her family was very sad that she went, but very glad that they paid 0 estate tax. A just reward for the widow of the man who invented the defibrillator. So be on the lookout. Now, can you convert a note to a self-canceling note instead of doing a private annuity? And there's reasons why. It's risky to do a private annuity from a dynasty trust unless the dynasty trust has a very large value. If you're in your early 70s, that dynasty trust needs to be worth about equal to what the assets put in for the annuity are, because of something called the probability of exhaustion test. Now, the probability that you're already exhausted now is low, but wait till after Jerry's done at 2 o'clock. That's why we're going to give you the 1 hour break, the entertainment by Don Noseworthy, in just 9 short minutes. So you can go to Tiger Tables or go to Number Cruncher and decide if you want to make your promissory note self-canceling. You have to pay a higher interest rate, and they only bring you to a life expectancy balloon, but you could manually calculate a longer balloon if you want the interest rate to be even higher. So I want to make sure I cover GRATs a little bit more here, and then I may have time for qualified personal residence trusts in the next 8 minutes. Okay, a GRAT. You are the grantor, your spouse is the beneficiary and trustee. You put in $4 million of anything. The GRAT agrees to pay you $1,976,000 the first year anniversary date. And actually, you can receive it 180 days late, like the US mail. And then the second anniversary date, $2,372,000 worth of something. So you put in $4 million worth of Apple stock, and after 2 years, the Apple stock has doubled, and there's going to be a lot in this GRAT. There's going to be a lot of value in this GRAT. It can benefit your spouse without ever being subject to estate tax in her estate or his estate, and then pass for your lovely children. And that's the GRAT. And the beauty of it is, if you undervalue the asset, the payments go up proportionally. You don't owe gift tax. So a couple of weeks ago, I think I showed this schedule where this company gets $3 million a year in income. So 10% of the company gets $300,000 a year in income. Multiply that by 5, it's worth about $1.5 million before discounts, $1 million after discounts. So, or maybe $1.2 million after discounts. So he puts it in the GRAT, and he's going to get $119,000 a year back from the GRAT for 10 years, and then after that, it's all for spouse and children. So what do you do here? You get 300,000 a year in the GRAT. The GRAT pays 119. It's left with 180,000. At the end of the 10 years, assuming a 7.5% rate of return, the GRAT has 2,500,000 and there's no gift. I like that. Plus it owns 10% of the company, which may still only be worth $1.5 million. That's a $4 million delta, is ready when you are, that you have here without paying any gift tax at all. But the GRAT needs cash flow. So what do you do to get the GRAT cash flow? Let's say that your only asset is a FLP interest, 41% that you own. And you want to put that in a GRAT, but the FLP doesn't pay dividends. And it seems, like it wouldn't make a lot of great sense just to get back limited partnership interests. So here's what you do. And this is based in large part upon outlines provided by Stacy Eastland, including pulling the rabbit out of the GRAT hat. You set up an LLC, and the LLC, you own 100% of it, and it owes you a $10 million promissory note. And the LLC receives 41% of the limited partnership, and the LLC receives cash and marketable securities. Now, these are similar to marketable securities, but they're from Greece. So they're marketable securities worth $4 million. So what is the LLC worth? I think the LLC is worth $6 million. The IRS thinks the LLC may be worth significantly more. Because the LLC owes me $10 million, by the way, I think if somebody came on just now, we need to mute you. It's either Professor Hesch or Noseworthy. Okay, that's good. So now what do? We, of course, form a GRAT. And we transfer the 99% non-voting member interest in the LLC to the GRAT. We're still owed a $10 million note. So the GRAT, if we use the $6 million value, only owes $1.6 million a year for 4 years. So now we've been able to take that discount on the FLP. We are bulletproof from a gift tax standpoint, as long as we have used reasonable appraisals commensurate with what other people are doing in this industry, nothing overly aggressive that would cause the IRS to try to say that the GRAT is not really a GRAT. And we are going to use the cash and marketable securities and some of the distributions from the FLP to make these payments. So now if the IRS says, hey, this FLP was worth $10 million more than you thought, well, we're sorry, we did our best. We understand that the GRAT owes more now, but there's no gift tax. That is a leveraged hybrid GRAT. And I have a chart here for the advisors. If you try to do this at home, then you could hurt yourself. But it does compare the skin to the private annuity to the GRAT. And I think I'll ask Jerry Hesch to come back here some Saturday, and we'll talk about this comparison. Finally, I promised that I would talk about qualified personal residence trusts, but I did not leave myself enough time. So I'll just get started on the Cupert discussion, and it'll be done in 2.5 minutes. Hey, Don. Bye, Don. Okay, so you put your assets in the qualified personal residence trust, and what you get in exchange is the right to use the asset, also known as your home or your vacation home, for a term of years that you choose. And because your children, who are the remainder interest beneficiaries of this Cupert, don't get to use the property for, say, 10 years, my gift of $1 million home to a Cupert that they can't have any benefit from for 10 years is maybe a $600,000 gift. I have to use the tables in Tiger Tables or Number Cruncher because it also is based upon my life expectancy and the term. And you know what? If I have a $2 million home and I only give half that home to the Cupert because Marcia owns the other half and she gives it to another Cupert, then I'm not even going to consider that $1 million in the first place. I'm going to consider it $850,000 and then take a 40% discount. So I've used very little of my exemption up. Now I get to use the house for free during the 10-year term. At the end of the 10-year term, I can continue to use the house, but I have to pay fair market value rent, which further reduces my estate for estate tax purposes, which is a good thing for me or for my children. Economically, not so good for me, but it helps me keep my estate under control. So I can set up a Cupert for Marcia and our descendants. Marcia can set up a Cupert for the descendants. My Cupert might be a 15-year Cupert because I'm 63. Marcia's Cupert might be a 20-year Cupert because she has a longer life expectancy. And so then in 10 years, I start paying rent, but she doesn't pay any rent. In 15 years, we're both paying rent, and all those assets are out of our estate for estate tax purposes. So we'll do a special talk on Cuperts in the not too distant future. And I did not answer any of your questions today. Let me just look. Frank liked the golf joke. Thank you very much. I don't feel so bad that I blew it. And then Stuart, in S-corp planning, if the grantor dies, does the trust have a Q-sub SBIT issues to deal with? Yes, but you can deal with the Q-sub SBIT issues, or the family can buy the stock back out of the dynasty trust for cash. Okay, Rob liked the Ukraine puppet joke, so I'm glad about that. And Sally, thank you for your patience. Okay, so now, based upon the miracle of modern technology, and hopefully and coincidentally, it will actually work, I'm welcoming my friend Don Gaylord, and I'm going to stop sharing my screen because I am very selfish. I'll see, how do I stop sharing my screen? All Carl icon.
No. Click on that.
Okay, so I wanted to learn how to be a less bad puppeteer, and I wanted to learn how to talk without moving my arm. So I'm not very good at it, by the way. So I went to Amazon and I found a book called Ventriloquism, Revised Edition by this. It was written by this puppet who hangs around with this guy Don Gaylord Bryan. So I had my assistant call Mr. Bryan, and this is how you make friends. I reached out to Mr. Bryan and I said, can you teach me how to be a ventriloquist? And after the second lesson, the answer was no, because I have no talent whatsoever.
Wrong.
But Don has a lot of talent. And not only is he talented with being able to make all these sounds with your mouth closed, which is really hard. I know a lot of you can't even try to imagine keeping your mouth closed during a conversation, but imagine talking and keeping your mouth closed during a conversation. That's difficult. So I met Don. Don and I have spent some time together. He's delightful and he's very talented. So I wanted to do a couple things. One, I just wanted to share the talent and the enjoyment of watching Don work live in front of an audience of estate planners and people who are interested in estate planning. And then secondly, I wanted Don to do a little presentation that I'm going to make into a YouTube video for him called The Biggest Mistakes That Ventriloquists Make. Because I've been watching a lot of ventriloquists on YouTube, and he's right, they do make a lot of mistakes. Now, my biggest mistake was trying to be one. But Don, welcome. And how would you like to get started here?
Well, hello, Alan. Can you hear me okay?
Hear you great.
Okay, great. I got rid of the headphones because I hate the feel of those. And so long as you can hear me, that's good. Well, Alan, thank you for that nice introduction and this opportunity to engage you and your audience, your people, in my craft, ventriloquism. Just to tell everybody out there, Alan really doesn't give himself enough credit. He's doing much better than he claims he is. We've had 3 lessons now. There's a lot of small technicalities that he will overcome in terms of lip movement and so on, and he's doing great. So Alan, don't put yourself down, okay? It's difficult for an accountant to be funny, I realize. No, I'm kidding you. Okay, so maybe I should just talk a bit about what I do, ventriloquism, and how come we're talking about it in your seminar, which is nothing to do with ventriloquism and has everything to do with investments, estate planning, and so on. Why me? Well, the interesting thing is, I think that one of the best ways to impart knowledge for people to take an interest in something is to have some comedy, have some laughs. Laughter is visceral. It creates a memory. It also gives an awfully good feeling and lightens up the atmosphere, particularly if you're engaged in what might be considered very dry discourse on estate planning and money matters and so on. So if you can inject a little humor into that, and even better still, you could use an avatar, let's call it that, your puppet, which would become the foil or the counter to everything that you're saying and doing, and ask the character, can ask dumb questions, things that maybe you wouldn't bring up or people wouldn't ask you because they feel a little intimidated by it, because maybe they just don't know and they'd like to find out. The puppet character can say, can call them out and say, okay, well, here's what you need to know, or not. And then, of course, you jump in and give us the real goods, the real information on what estate planning and wills and all that sort of thing is about. Anyway, ventriloquism for me, without going into a long story, began when I was 15 years old. I used to watch television, of course, and mostly radio in those days. Egdeberg and Charlie McCarthy was the act in those days. Some of your listeners will know who that is. Bergen was huge on the radio. Imagine a ventriloquist on the radio, right? It's like a mime doing a CD, as I always say. But he really sold it, and he was a brilliant comedian, and the character Charlie McCarthy became real to many people. It was a big show in its day, and big Hollywood stars vied to be on his show because it was a prestige to be on the Egdeberg and Charlie McCarthy show. It was huge. Anyway, that's what started me, and I got a book on it. That's where I began. And then I met somebody, a gentleman who was a master carver. He taught me how to build puppets, carve dummies. In fact, this is one that I'm doing for you, Alan. He's
like,
in.
looks just like especially the flat head at the back. Yeah.
Yeah, the flat head on the back. That part we got to work on. But anyway, this is something else that I do. I carve and build the dummies. We can call them dummies, okay? Some people get a little embarrassed and they say, what do we call your characters? We don't want to say dummy. No, it's a dummy. It's a puppet. It's a dummy. And of course, the character has a different point of view about that. So anyway, over the last, I could say easily 55 years, I have been performing as a ventriloquist, as an amateur, and in later years as a professional. I have worked in every conceivable venue that is possible to be in as an entertainer. And I've had a few shots at television. I've worked with some big stars and as an opening act, and continue to work as a ventriloquist, mostly these days on cruise ships when they're sailing, and they are again. So that business is starting up. Anyway, ventriloquism is something which I think is, generally speaking, most people, it's a mystery. How do you throw your voice? Well, you don't. You don't throw your voice. It's an illusion. It's called, I would say, in Ron Lucas's words, ventriloquist of the 80s, he used the term vocal magic, and totally right. It's vocal magic. It's the art of misdirection. The better you are at keeping your lips still and disguising your voice and directing people's attention to where the source of the voice, supposedly it would be a puppet. It doesn't have to be. It can be behind a door, under the table, in a closet, in a suitcase. But that's just modulation of the sound, of creating the sound. Again, imitating what would sound like a voice coming from whatever source you want to suggest, be it a puppet or, as I say, from a hidden source. You direct people's attention to it. You create the voice that would sound like a voice, say, in a suitcase. That would give the illusion. That's how it basically works. It's not something that you have to be born with. I often have people say, well, you're a ventriloquist. I guess you were like automatically ordained to be a ventriloquist because you had certain vocal unique characteristics. No, I don't. Anybody can become a ventriloquist. Doesn't matter how old you are, how young you are. It works. You just have to learn the technique. It's like learning to sing, say, or play an instrument. Your instrument would be your voice. You learn how to create the sounds and the character sound, character voice, whatever it is that you're working with. So that, to me, is something I would like to pass on to people and say, look, if this is interesting to you, take a look, pursue it. It's a very rewarding hobby, and it has been for me originally a hobby and became a full-time profession for me in 1986. And I haven't looked back since. I've been very, very happy with my work as a ventriloquist. The fun and laughter I brought to many people over the years is wonderful for me to have been able to do that. I've had people come up to me with an elder, say, in a wheelchair, somebody who has a serious illness, and their caretaker or their relative tells me that it's the first time they heard him or her laugh in a long time. They had a lot of enjoyment out of it. I think one of the best things too about being a ventriloquist is that through the avatar, I'll call it, the puppet, you can express and say things that perhaps you yourself would be uncomfortable with, right? It's an alter ego. It's still you, but it's a side that you can express through a puppet. Kids know this. Young kids love puppetry. Why? Because they can relate to a puppet much more easily, actually, than to an adult. So they will talk to a puppet. They will say things with a puppet. They will engage the character and enjoy the fantasy of it. And it is a fantasy. You have to suspend reality in order to, I think, become a good ventriloquist or puppeteer. It takes some years of practice, but you can learn the basic techniques, Alan, within a few months. I still have a few more lessons to go with you. Alan's he's doing okay. There are difficult parts of the production of the sound. Excuse me. Learning how to say difficult letters and words. You can use substitutions. You can say B, but you can actually make a D sound like a B. But there's all manipulation of your vocal equipment, your tongue primarily. And
Show
of
us,
course, you
bring on a dummy and bring on a dummy and show. Bring on a puppet and show us.
you want me to stop talking and bring on a puppet. Okay. I have some characters here. My main character I call Noseworthy. You know who that is, Alan. I created Noseworthy back in 1964. He was actually a cartoon that a friend of mine drew, and eventually I got around to building it. So this is my friend Noseworthy. We'll just bring him into the picture.
Oh, I'm not comfortable. I'm sorry. Oh, that's Alan. Hello, Alan.
Clear your throat.
Thank you.
Right.
Oh, Alan, how's he doing?
Well, I don't know. Ask him.
How you doing, Alan?
Doing great. How are you? How are you
Oh,
doing?
Not too good. Not busy right now. Just sitting around, in a suitcase a hell of a lot of the time.
Watch your mouth.
Can't nose cuts off as you. Don't bother me.
All right.
Yeah.
So Noseworthy is I guess a kind of a phenomenon for me because,
What?
well,
Yeah.
I'm talking.
Okay.
Yeah.
Talk.
I'm trying to.
Yes. Okay. He's trying to talk.
Right.
But he's talking to himself.
All right.
This is what happens when cousins marry. Will you shut up?
Where was I?
On board a ship.
No, not right now. Noseworthy is an interesting character.
How?
Well, because you don't look like the standard dummy.
I beg your pardon.
It's the regular looking puppet.
Oh,
Right.
yeah.
Most ventriloquists sort of went after the idea that Edgar Bergen and Charlie McCarthy established.
Yeah.
Young cheeky boy character, as we call it.
Cheeky boy.
Right.
Yeah, I'm a cheeky old man.
Yeah.
Like you. Yeah.
Mhm.
Yeah, you're an old man.
I'm not that old.
You're old.
I'm barely touching 70.
Touching, you're beating it to death.
All right, fine. See how it goes?
Yeah.
We keep having arguments.
Yes, he talks to himself and plays with dolls.
Thank you very much. So, Alan, this is my main guy,
Yeah.
ladies and gentlemen.
Yeah, Noseworthy.
Noseworthy.
Yeah, can you say that without moving your mouth?
I think I did.
Okay, Noseworthy.
Right.
Noseworthy. Not that good.
I'm working on it.
Yeah, you need practice.
Right. Yeah, he's my own worst critic.
Yeah.
As you can see behind us,
Yeah. Who?
well, that character.
Oh, her.
Right.
Oh, God, not her.
Yes, well, I call her Miss Annie,
Yeah.
and we're going to introduce her now.
Okay. All right, Miss Annie. I don't like it.
Never mind. She doesn't like you.
I don't like
Now, one of the things I want to point out is that, excuse me, is that character voices are something which we all have the ability to create. It's a matter of a range, high range, low range. When you're talking in the ventriloquist dummy's voice, of course, you want to be able to hit the voice every time the same. So now, excuse me, my back. All right, here we go. Okay.
Hello.
Yeah.
Hello.
Hi, how are you?
Oh, I'm fine. Little fire hazard.
Yes, I know.
Yes.
You and Noseworthy never did get along.
No.
No. This is I'm sorry.
Yeah. You okay?
I'll be all right.
Yeah.
This is Miss Annie.
Thank you.
I created, built about 3 years ago.
Sure.
And she's the third Miss Annie that I've actually worked with and created.
Oh, there's others.
There are others.
Oh, that's nice.
Yes, that's nice.
I'm the current one.
You're the current one.
Yeah. He's not married.
No,
Don't touch me there.
sorry. No, we don't need to talk about my personal situation.
It's critical.
Well, I don't think it's important.
I don't think you know.
Look, I don't want to go there.
All right, fine. He's only got me.
Yes, you're it.
I'm it.
Yeah.
Without me, he's just talked to his hand.
Yeah. Oh, well. Miss Annie is a foil for Noseworthy.
Thank you.
And they never got along.
No, he's a piece of work.
He's his own worst enemy.
Not when I'm in the room.
No.
Okay. Oh, dear. Oh, here.
Yeah, I'm going to put you back here. Don't fall, okay? Just be steady. Yeah, okay. Well, now, Miss Annie was an evolution of a character that I started with, very difficult for me because I never planned on having a female presence in my act. But I figured, well, you know what? I need that. Noseworthy needs a partner and somebody that they could bounce off of each other. And the material runs pretty much like a couple who just constantly at nagging each other, kind of how it goes. I work both of them together. I also use a radio control, which she can work on independently while I'm with Noseworthy over here. She's over there talking and doing her thing, but that's all done electronically and wirelessly. It's just a little gimmick. One of the things that I'd like to show off, which is so simple, and it was just a discovery that I made many years ago after watching a juggler work with a tennis ball. And tennis ball, this is a little larger than a regular tennis ball. It became a puppet for me quite simply by just cutting that slot there. You get a mouth and then a couple of buttons, if you like, with Velcro.
Hello, hello,
Oh, the voice is really hard to reach right now.
hello.
And
Sure.
Dennis.
Dennis,
Yes. What's your name?
Dennis.
Yes. Whoops, we're losing an eyeball.
I know.
How are you?
Fine.
What do you do?
I'm a bouncer.
You're a bouncer.
Yeah.
Why don't you smile?
Can't.
Why?
Not cut the right way.
Oh, okay. Well, I'll give you a little.
Oh, that's weird.
Okay, here we go. Now you're going to be a little happier.
Ah,
What do we have now?
eyes on my butt.
Eyes on your butt.
Yeah.
All right. So, you know, it's a very simple thing. Anybody can create that. I find that as I've gotten older, my voices in the high range are more difficult to reach.
Is that so?
Yes, that is so. And I have to really work on that. When I get back out on the road again, I will have myself tuned up, let's call it that. Okay, so you've seen a couple of things. Let me show you one more here. This is a novelty. Yeah. Now, this character, ladies and gentlemen, as you can see, yeah, he's a bird. Yeah, actually a vulture. Oh, and a canary with a glandular condition. Well, nice to have you here. I'm sorry. What's wrong? Little cough. Thank you. Who that? Oh, that's Alan. What do you think? Tasty. Yeah. Oh, yeah. He's not dead. I can wait. I know you can wait. Yeah. He's a budding ventriloquist. What? Learning ventriloquism. Oh, I see. Yeah. Good luck, Alan. Okay, that's it. Yeah. Oh, dear me. I'm sorry, Alan. I'm having a little issue with my throat this morning and had a cold a couple of weeks back, and I'm still not done. Okay, so those are my three main characters that I generally work with. I have another one which I will quickly show you. I don't use them particularly that much. Reason being is that traveling with all these extra characters is a bit of a pain because the flying with all these suitcases. Yeah. Hello. How you doing? Yeah. This is Chester. Yeah. Chesterfield. Oh yeah. And that's Alan. Hello, Alan. Hello. How you doing? Oh. Okay. Yeah. So what do you think? Well, what do you think about this? What we're doing? What are we doing? You see yourself? I need a haircut. Yes, you do. Oh yeah. Well, I'm done. You're done. I'm done. Not much to do. No, you're getting kind of noisy. Yeah, I know. I need oil. You need oil. Yeah. Chester is a character which was created by a friend of mine, Tim Selberg. he is a master builder of puppets, and he works mostly in cast characters, and he creates them in numbers, meaning by that duplications. And this character here is available, or at least it was. I don't think he has it anymore, but it's available if you want to order it in his catalog. And he has many other things that he produces as well. He's very, very skilled. Most of his work is done in cast fiberglass or plastics. And I prefer to work in wood, as you know, Alan, wood. So old school I am, and I have for years enjoyed, fiddling around building a few puppets. Well, I probably have built over 30 characters over the years, for other people and for promotions, for television commercials and so on. And anyway, that's sorry, that's my story. Basically, if you have any questions, Alan, please.
Yeah, we have one question is, how long does it take in terms of how many weeks would it take and how many hours a week would it typically take for somebody to become reasonably proficient?
Well,
Well,
I don't know quite. I'm not talking to you. Okay.
all right. I'm talking.
And well,
Okay, yeah. Well, I would say, well, you know yourself that you've been working with it a little bit, and it requires, I would say, a couple hours a week, maybe, going through the basics, which is lip control, voice modulation, and being able to create the illusion of another voice, not yours. How long would it take? It depends on how much time you want to put into it. When I was a kid, I was 15 when I started. I was messing around with it. I didn't think I was that good, but apparently I was getting away with it because the kids at school, accused me of having a tape recorder inside the puppet. Well, that told me I guess I was doing okay. You can learn, find a voice that is comfortable for you, and work with that.
you want to try a voice like that? That's okay.
You have a voice similar to that you've shown me already with your little character, and that's fine. That works fine. As more and more you work with it, the more easily it'll be achievable. The voice will happen as you go into pick up your character and start working with it. That voice you will find it. The technique, yeah, it depends on, as I said earlier, about how much time you're willing to put into it. It's a very rewarding skill. You don't have to be 100% perfect. And as I said earlier, if your animation of the puppet is good, that you bring it to life. I have seen ventriloquists who weren't bad at the ventriloquial, nice word, huh? Ventriloquial technique, but they had no concept of keeping the puppet actually alive. They would talk and the dummy would just go dead. We would just sort of, and then he'd finally, after his spiel and whatever he was saying, he'd turn to the dummy and the dummy would look at him and start talking, say a couple of lines, and it would go dead again. And he would carry on with his story or whatever. So this was kind of like, the dummy was just, a novelty, an afterthought. It wasn't a character that was living. You want it to appear to be alive. And the character, his eyes are moving, its head is turning, it's listening, it's responding. It can't obviously have facial expressions change, but you can create the illusion of mood, if you wish, with the character, the eye movement, the head tilt, the character looking off screen, engaging with somebody else in the audience, perhaps, while the ventriloquist is trying to do his routine and the puppet's doing his routine, right? So that splits you and the character, and it adds fun and reality. I've had situations where, I've been doing a spiel and the dummy knows where he gets bored with me and he starts flirting with a girl in the audience, And I tell him to stop. That's not nice. She's nice. No, she's not. Don't talk to her. Okay, she's looking at me. I know. She really likes me. That's your imagination. No, it's her imagination. Blah, blah, blah. So we got sidetracked. But that's it. That's the humor. That's the fun part of it. That's what gives you and the character a split in terms of two people, not just one. People, you'll get a compliment when people say to you, I swear there's two people on stage and yet it's still just you. And that's the way you want it to come across. Oh, you've gone muted on me. You're
Sorry
still
about that.
muted. Oh, there you are.
There's something that happened to you when you were pretty young that I think a lot of people on this webinar can identify with. You met a hero and he sat down and gave you some time and completely, and I think it completely changed your life. And, you know, anytime that you can line a young person up with somebody who could really just change their life, and a lot of people on this webinar have the ability to go reach out to a young person, a mentee, change their life. So just tell us a little bit about that event, because I think it's a lot more significant than you do.
Well, yeah, interesting. And 1969, I think it was, my dad was working in a local film production. It was a series called Littlest Hobo. It's about a dog that rescued people and caught criminals and helped the police and so on. You know, kind of a Lassie thing. And they had a series, and it went every week for several years. Black and white, by the way. My dad was an actor, and he got a job on one of the series as a bartender. And in that particular one, that particular show, Edgar Bergen was a guest star. And he was here employed as a sideshow barker kind of thing. And he was doing, you know, sidewalk shows and stuff like that. That was the character that he played. Anyway, Dad told me that Bergen was in the show, and would you like to meet him? I says, oh, yeah. And Bergen was very kind, and he invited me to join him for dinner at his hotel. And I was just like blown over with that. I didn't know how to, I was so starstruck, I didn't know how to react to him. So anyway, I packed up Noseworthy in a little suitcase and took him along, which was a good move. And I checked the suitcase at the reception in the restaurant hotel and went to join Mr. Bergen. And he was sitting there eating his steak, kind of like just acknowledged me, but didn't say very much. And I just watched him eat his steak. And then he put down his knife and fork, moved his plate aside, put on his glasses, and said, so your dad tells me that you build puppets. I said, oh, yes, Mr. Bergen, I do. He says, well, have you got something you could show me? I said, well, as a matter of fact, I do. So I went out to the front desk, picked up my suitcase, brought in the restaurant, took out Noseworthy. No, it was Clarence, pardon me. My first kid, little boy puppet, Clarence. That's way before Noseworthy. And he looked at it, he put on his glasses, he looked at it, and he was quite impressed. He says, your work is very good. I will recommend you for anyone asks me where to get dummies, puppets. And I was like, oh gosh, I was just like, oh, Mr. Bergen, thank you so much. He wrote me a little letter, which I still have on his personal stationery, touting my skill as a figure builder. He never really saw me work as a ventriloquist, but he looked at me as I was doing my little demo, and he says, wait a minute, he says, your voice you're producing, I was actually producing the voice, as we would call it, the distant voice. Hello, hello. It's down deeper. Hello, how are you? No, he says, bring it forward, up here.
Yeah, okay.
Oh, wow, okay. Now, all of a sudden, the voice was projecting. It was much cleaner and clearer, and that was the best bit of advice I guess I ever had, because that sort of got me going, because I'd learned everything about ventriloquism from a book, which really wasn't too clear on some of these things. But nonetheless, Mr. Bergen was very, very generous he kept in touch with me over the years. He sent me a few autographs, 8x10s, which I still have, cherished memorabilia. And we corresponded a bit over the years. I never took up his invitation to go down and visit him. He had a restaurant in LA called the Gourmet, or the Gourmand. I think it was called the Gourmet, was his restaurant. Unfortunately, in those days, I was just not able to do that. But that was the beginning for me. That kind of really opened up my eyes to the possibilities and the fact that maybe I wasn't as bad as I thought I was as a kid. You know, had no idea at what level I was at or how good I was or anything about it. I knew my puppets were pretty good. So yeah, that was kind of the big aha moment for me, Mr. Berg, and meeting him. And even to this day, while performing, I still use a lot of his style or technique. I learned how to, you know, by watching him, and even to this day, I can still look at some of his old videos, which you can find on YouTube, and watch him work with Charlie and how Charlie comes alive. And that puppet was a very simple little boy character in a top hat and a tuxedo. It came alive for me. It didn't have any special animation, just a moving mouth and the head, and no moving eyes, no eyebrows, no gimmicks. And it was really simple. And it was, to me, the absolute best example of ventriloquism, manipulation, puppetry, call it what you want. But I always, that was my touchstone. If I ever wanted to sort of get back to what I really believed in terms of how to present myself as a ventriloquist, I would look at Bergen and say, oh yeah, I remember now. And it always inspired me to watch him work, even to this day. So
that's a great example, again, for professionals and business people on this webinar, that go help some young person and be a mentor and go find someone to model, because you modeled him.
That's right. You're so right. And the same thing applies. Sorry, Alan.
Said to meet him personally and be able to model him and be getting letters from him. That made a big difference, I'm sure.
Well, it did. It opened up a whole new world for me, and I became so. Oh, what happened? You disappeared. I see you. I don't hear you. What happened?
Here I am.
Oh, okay. Good now.
Yeah. Sorry about that. Hey, somebody has a question for you.
Yes.
Do you write your own humor or do you use stock humor, whatever that is?
Yeah, well, stock humor is like, when you start out, it's like, well, you know, unless you have a natural bent for comedy or like a comedian and like write all the time and you come up with ideas, and that's how what comedy clubs were so good for, because you could go in and work out material and you would die or succeed, or you could sort stuff out. I find that when I started, yeah, I went to comedy books. I would listen to TV, sitcoms, anywhere I'd hear a funny line, something I liked, I would use it. And then in time, I eventually created my own material, often around an idea that maybe I picked up from something I read, or a sitcom that I was watching that gave me an idea for a line of material that I just developed myself eventually and added more to it and created more. And that's kind of how it works. It's an evolution process. Yeah, writing material is probably the most difficult part of putting an act together, is creating original material. I still have struggles with it.
You're writing some estate planning material, I think.
Yeah, yeah. Noseworthy and I have some thoughts on that. Hold on a
Don,
minute.
let me interrupt you though. We lost your video.
Yeah, I just got me in a little corner up here. Let me see.
We do.
Share.
I sent you a video cam request.
There we go. All right.
I think it was my mistake. I need a drink of water. Yeah, estate planning. That is something which Nosri and I have been discussing and do not agree on. Nosri,
What?
we need you.
Oh, God, again.
Yeah.
Is Alan still there?
Yeah, he is.
So, hi, Alan.
Hello, Noseworthy.
I think you aged.
No, don't be rude.
I just having fun.
What are we doing? Well, estate planning.
Huh?
Estate planning. This is what the seminar is all about.
Oh,
hmm
estate planning.
That's right.
Uh-huh.
Yeah. So what happens?
Yeah.
Let's say I'm not around anymore.
Yeah, I still work.
Well, no, you don't.
No. What happens to me?
What?
When you go?
What happens to you?
Yeah.
When I go?
Yeah.
Well,
Yeah.
I might. I'm not going to a museum. Okay. All right.
I'm not doing the museum.
I didn't say that.
Okay.
All right.
Alan, you interested in a new partner?
No, not yet.
Soon.
Right.
I could work with him.
Yeah.
I think he's got more money than you. Yeah, thank you.
Yeah.
Yeah.
So
Yeah.
we have an estate.
Yeah. We're in a state.
No. We have an estate.
Yes, we do. He's got tools.
Yeah. Tools. You see, the thing is, you and I have had this relationship.
Yeah.
We have a symbiotic relationship,
I never touched you.
meaning
Yeah.
that we rely on each other.
Yeah.
We are a team.
Oh.
Yeah, you see, and we need both of us in order to make the team work.
Yeah.
To make it work.
How clever of you.
Right.
Not so quick.
All right. Well,
Yeah. Go on.
well,
Go on.
I'm trying to.
Okay. Just don't drag it out.
Well, I'm trying to. Yeah, you keep interrupting me. Keep your mouth shut when I'm talking.
You don't keep your mouth shut when I'm talking.
Oh, here we go.
Doing jokes again. What?
Okay. So, okay, the deal is
Yeah.
that we have to think about our future.
Yeah. It's already here.
Yeah, you're right about that. So,
Yeah.
I don't know. I'm thinking,
What about my inheritance?
your inheritance.
Yes.
Like what?
What do you got?
Well,
Do you have an income?
would you have money? No, not.
Well, what am I going to live on?
You're gonna, yeah. What you find work.
I see. I'll find work. This does not sound too good, Alan.
Mm-hmm.
I think I'm in deep trouble.
Maybe you are. Estate planning, yeah, isn't something that we have ever thought about.
No,
Mm-hmm.
no, we did not.
No. So how are we going to deal with it, huh?
Well,
Mm-hmm.
I know. I'll go first.
No, you. No,
Yeah, I guess I'm not going anywhere.
no, you're not.
No.
It is something which I suppose we need to one day think about.
Yeah. What do I inherit when you go?
Well,
Huh?
well,
What do I get?
well,
I get a suitcase. I know that.
yeah. Well, you probably, well, you'll probably have a nice, comfortable situation.
What's that mean?
Well,
Yeah.
there's a museum.
Not doing it.
Look,
Yeah, I'm not going to the doggone museum. No, I'm not. I'm not a museum piece. I'm not a woodcarver. I'm not a
look, you heard of the Ventriloquist Museum?
Yeah, a bunch of dead dummies in there.
Yeah, well, it's a collection of ventriloquist puppets that go back hundreds of years, actually.
No,
Mm-hmm.
that old.
Yeah. It's in Fort Mitchell, Kentucky. That's near Cincinnati.
Yeah.
It's a collection, a private collection that grew into now what is an internationally renowned collection of very unique and unusual ventriloquist paraphernalia, dummies, and all things to do with ventriloquism.
So
Well, wouldn't you like to go there one day?
no.
Well, we've been there.
Yeah.
Yeah, we visit every now and then because they have a convention, a ventriloquist convention it's usually in July,
Yeah.
and they have ventriloquists from all around the world come to attend that,
Yeah.
tour the museum, do shows, workshopping, swap and shop, all kinds of things. If you're interested in the world of ventriloquism,
Yeah.
that's where you want to go.
So that's where I'm going.
Well,
Is that my end place?
your end place, it could be.
Is there money in it?
No, not for you.
Oh, thank you.
Yeah. Well, the ventriloquists eventually, of course, disappear.
Yeah, you're right.
Edgar Bergen, for example, his characters, Charlie McCarthy, Mortimer Snerd, F.E. Clinker. Oh, yeah, yeah. They are now installed in the Smithsonian Museum. Oh, that sounds like fun. No, they're not. You can go and see them. It's a piece of pop culture, of American culture many years ago. And it's still relevant today because depending on your age, of course, yeah, not everybody in the younger generations knows who Edgar Bergen and Charlie McCarthy were, but that is a piece of Americana, piece of history, entertainment history. Yeah, and particularly because it was a radio show that was so famous. He also eventually did television and some films. He worked with W.C. Fields. Yeah. Charlie and Fields always had this feud, which was fun stuff. And, they're always at each other. Yeah. And that's a little bit of what Noseworthy and Miss Annie get into, is a bit of this back and forth insults, if you like. Yeah. Oh, not insults. Well, I think so. So, Alan, show me a quick little alphabet thing like ABC. Do that.
A, G, C, D, E, F, G, H, I, J, K, L,
That's
M.
enough, Alan. That's enough. You got to charge him more. I know. Yeah, you're doing okay. You just got to keep working on it, Alan. Yeah,
Can you say the Peter Piper thing? Can you say Peter Piper?
He can't. I can't. No, wait a minute. I don't. I haven't rehearsed it. You can't do it. No, well, I haven't. Why did you bring that up? Because it's really worthwhile knowing. No, I can do it. Peter Piper, tickle peckers. Peter Piper, tickle peckers. How many peckers can Peter Piper pick? Make you look good, huh?
Wow.
Oh, thank you so much. It was hard on me. Yes, I'm sure it was. Okay. Yeah, that's a little bit of flash, I guess you want to call it. Yeah. When you get to the point where you're comfortable with doing tongue twisters. Tongue twisters? How about supercalifragilisticexpialidocious? Well, yeah, that's a good one. That's a good one. That's a really good one. Yeah, he can't do it. No. I would suspect that everybody has a skill level when it comes. Some people are natural when it comes to singing, or are good public speakers because they have a presence on stage. Yeah. As a kid growing up, I was shy. What? I was very shy. You were? Yes, I was. I could not get up. Are you kidding? Get up on stage and talk to people? No, I couldn't do that. No. But once I had my sidekick, yeah, made you look good. Then all of a sudden, I was not responsible for what the character was saying or what I was saying, because the character was doing it. I got away with a lot of stuff, and the materials kids basically when I started out, and eventually, of course, it evolved into an adult show, I guess you could say. But my confidence grew as the character became more and more successful. And as I became more and more successful, nowadays, when I, particularly working on the cruise ships, I have become very comfortable in that environment. I can relate to that crowd very well, because you are that crowd. And I can actually do about a 5-minute stand-up routine before I bring out Noseworthy. Yeah, that's what we do. And that's been really good for me. I've learned a lot by having myself out front. It was very awkward when I look at my early videos of me going on stage before I actually started the act with Noseworthy. I'd have a couple of minutes of getting comfortable, and I'd be shuffling around on my feet. I'd have the whole posture, my whole body language showed that I was not comfortable and that I was really wanting to hide and couldn't wait to get the puppet out so I didn't have to do anything. No, and now you're just doing it with me. Yeah, without me, you'd still be talking to your hand. Yeah, that's right. Yeah. So it does build confidence. It is nice having a partner, a backup, as I use the term avatar.
Yeah.
And that way, it's not you, it's him, it's the character, and that gives you license to get into a lot more fun comedy, ask silly questions or say silly things, and it's comedy. If it's funny, it's funny, and without being crude or rude. You don't have to be blue in order to be a funny ventriloquist act.
Yeah.
hmm
On your own, you're no good.
Well, I'm okay.
Yeah.
I can get away with it.
Yeah, you get away. I do. You don't. I do. You don't. You don't.
I do.
Yeah.
Don't listen to him.
He's doing it again. Look, don't argue with me. I'm going to get annoyed at you.
Yeah, we.
You know what? He's not well.
Okay, thank you very much.
Okay, that's it. That's it. No more things about retirement. When are you going to retire?
I'm not going to retire.
God, you should.
I know. Alan, I don't know if this is any good to you, but
Oh,
I've had fun doing this. I hope your listeners find it entertaining, and perhaps give you folks a little bit of an insight to maybe just trying something a little different. It doesn't hurt to inject comedy into almost any presentation that you have, because I mean, you've watched TED Talks, and there are some amazing examples of how to capture people's imagination and interest. I don't think I've ever seen a ventriloquist on TED Talks, now that I mention it, think about it. And as a tool, ventriloquism,
I'm not a tool.
you're not a tool, but it is a very, very, how do you say, a very nice way of presenting material that perhaps you yourself might find either a little dry, a little difficult to put across, needs a moment perhaps of enlightenment, a little comedy, a little break, an icebreaker. As you do, Alan, you're using your character that way. And it works. It works very well, as you know how popular and response you've had. And you're not even doing that much ventriloquism. You are now. You're starting. But even without the skills as a ventriloquist, you were just showing the character as a puppet. A puppeteer would. A puppeteer works usually off camera or behind a screen, right? So they're not engaged in the conversation. But ventriloquism, it's a straight man comic team. So one works off the other. And that gives you so much more, I think, flexibility. And it's back and forth from reality to fantasy, if you wish. Anyway, I can't say enough about it. I think it's ventriloquism has been really good to me. I've traveled the world. I've had amazing experiences, good and bad. I remember I did an evening at the Improv back in the 80s. Remember that show? And I was auditioned for it, and they said, "Oh, we'd love to have you on the show, but we don't want the old man character, Noseworthy." And they said, "No, we'd rather have the bird character." I said, "The bird character," but it was brand new then. I hadn't really developed anything with it. So I said, "Yeah, sure, okay." And then I had to figure out what the heck I was going to do with the character that I hardly done any work with. And so I took the bird out and did a little routine. And there's a routine at the end of the routine where the bird spits. It's like a stream of water. And it's like he does it saying like, "I'm looking for something to eat, looking for something to eat." That's what well, I got to test and see who's alive and who's dead and who's not and so on. So, proof of life, he shoots the water, and if they move and jump, he says, "That one's alive, not ready yet," that kind of thing. Well, shot the water out, and this poor woman sitting right by the stage got it right in the eye. And I went, "Oh no." And I'm going, "Oh my God." I didn't know what to do. It was horribly embarrassing. It didn't hurt her. It was just water. And it wasn't serious, but it really kind of blew it for me, just if I'd had Noseworthy, yeah, I might have had a different outcome. But anyway, it was just one of those things. Never go out unless you prepared. Like Bergen often said, opportunity when preparation meets opportunity, that's when you succeed. The other thing I heard that also it says something to me is about learning, about launching yourself into a new adventure. If you continue to think like you've always thought, you will always get what you always got. And I thought, you know what, that talks to me, because if you're not willing to make change, you won't make progress. And progress is change, change is progress. So if you can't change your mind, you won't change anything.
And we have one more question from Rob.
Yeah.
And he says, can you talk about the mechanics? What makes the puppet come alive? The eyes, the mouth, the eyebrows. How do you do all that?
How do you do all that? Well, how do I do it? Well, when I first started learning how to build a puppet, I used to sit in this workshop, this old gentleman that I had met in a toy shop one year in the Christmas back in the 50s. And he saw my interest in puppetry. He had some puppets he was demonstrating in the toy shop at Christmas. And I was fascinated because I was trying to build a puppet from a book that I had by Paul Winchell. Some of you might know who that was. He was a ventriloquist that sort of was the next one in line after Edgar Bergen. Paul Winchell was a television ventriloquist. He wrote a book called Ventriloquism for Fun and for Profit. I had that book. That's how I learned initially to build a puppet. And it had some very basic technique in terms of mechanics. The mouth was just with okay, there was a pin through here, and the jaw was on that pin, and it would go up and down, and the spring on the back would return it, right? So there was a string that opened the mouth. You have it goes down to the handle. Okay. There's this head stick or handle, and in this case, there's a trigger. That could be either a string or this one. In this one's case, it's a rod, right? And the eyes are on this device here, which is just back and forth. And then there are the eyelids, which in this particular character are quite unique. They have independent operation as well. That's all done with cables. And it gets way more complicated than that. If you want to get into it, there are many other animations. Raising eyebrows, your character that I'm working on, your little Alan guy, he's going to have raising eyebrows, left, right eyes, and a moving mouth. Good, yeah, really good, really good, really good. So, and then there's a trap door in the back there, and that's how you access the mechanics, because things do go wrong occasionally. If it's a string, it might break or fray. Springs over time need to be replaced, so on. So you can get into it that way. The mechanics are basically for like just the moving mouth. It's very simple, and the eyes a little more complicated, but nothing really too amazing. It's simple mechanics. Now there are friends of mine who stateside who build figures with eyes that have 360-degree movement, if you like. They go up, down, sideways, blinking eyes, raising eyebrows, wiggling ears, upper lips that go up so they can have a smile with the upper lip showing. And there's so many other bits and pieces that you can create. I've never gotten into that. I never learned all those things, although if I need to, I suppose one day I will, just to try it out. Your character is going to have moving eyes, left, right, and eyebrows, and a mouth. You're muted now.
I keep muting myself to have better bandwidth. So, yeah. So I want to close here, but I want to make sure I mention that the lessons have been very inexpensive and very enjoyable. So if anyone here would like to take a lesson from Don, or has a young child that would like to learn, because I started ventriloquism when I was 11 or 12, and I played with a dummy, and so that sort of gave me an inkling that I could do it. But boy, you put a 7 or 8 year old in Don's hands by video calls, they can really be doing a great job. But then you also do corporate events, which,
Yeah.
you know, when Marcia first met you for my second lesson, and just the way you and Noseworthy spoke to Marcia and teased her a little bit and teased me a little bit, you'd be really smart to do like a birthday call. I mean, anyone who has a young person or a friend, just to have a birthday call from Don, I think that would be, you know, great, because after about 15 seconds, your mind forgets that that's a puppet and you think it's a little man. The other thing I want to mention is what we're doing, or what I'm doing when I start my little talks with that silly little puppet, is I'm letting everybody use their inner child. You know, as adults and so serious, and, you know, I need to know about estate tax. Well, let's use the inner child a little bit here and laugh a little bit and just enjoy. And as stupid as my humor is, everyone loves it so much more than anything else I do. So for those of you who are out there, I could just tell you, why do I use these puppets? Is it my business model? Well, actually, I love doing them, and I think it's really cool, and I play with them. But it's also a good business model. It works well. So,
well,
Don, thank you so much.
Well, thank you, Alan. And you know, your take on this is really refreshing and inspires me also, because you know, after all the years I've been doing this, I've been always wondering, like, what else can one do with this that would be helpful, that would be useful, not just fun, but also serve a purpose. In some cases, like I said, I was a shy kid, very shy, and this kind of brought me out of my shell, if you wish, and over the years evolved into something more, much more interesting. And I think anybody who wants to do it just for fun, they'll have fun with it. Absolutely. If you want to incorporate it into your business model to illustrate the idea of being able to inject comedy and a light side to your more serious material or your business, why not? There's nothing wrong with it. People will enjoy it, as you've experienced, Alan. Your feedback has been all positive about it. And thank you so much for including me in your presentation. I'm flattered that you would do that. Thank you.
Yeah, I'm gonna get you involved in some children's charities too, whether you like it or not, and we'll make some kids.
I'd love to do that. I used to do charities, and when I got involved in the other end of the business, mostly working ships, I was always away, so I was never available for work. And now that's tapered off, and you know, it's coming back, but I don't want to do as much as I was doing before. I'm just not interested in traipsing across the world with all my luggage to join a ship in Hong Kong or something. It's all been fun and interesting, but you know what? I can have just as much fun working a little on a smaller scale and more locally, and trying new things like what we're doing today.
Yeah. So, all right. Well, Don, thank you so much. Jerry Hesch is on, and I hope you and Noseworthy have a great day today.
You too, Alan. Thank you again, Kelsey, for helping us out.
Oh, it was a ball.
I think I know how to shut this off. Okay.
Just leave webinar, or you can stay.
There's Jerry.
Hey, Jerry. Okay, I'm going.
All right. Take care.
Thanks, Alan.
So, Jerry, do you know what job Kelsey had before we hired her?
She was a dancer at the Rockettes.
No, that's her hobby. She was a kindergarten teacher in the public schools. So my office manager said, she's perfect for you, Alan. She'll be able to try to keep you in line.
Okay, Mr. Hesch, you should have control of your.
Professor Hesch. But why is he purple?
Yeah.
It's a problem we have with my background, and we couldn't fix it. So It's like, it's there. I don't know what it is. So it just,
Professor Hesch, you should have control of the slides now. Give it a shot, okay?
okay, where are they? I'm looking for it. I can't see it.
On your main screen? Are we sharing our screen?
I'm looking on the main screen and I don't see it. I don't see the toggle at the bottom.
Okay, you have
Oh, maybe it's our side.
you have to click on it.
Oh, I found it. Okay. Ready?
We're ready.
Okay. All right.
Jerry, do you want to, before we start, do you want to just mention the dates for Notre Dame and whether we're hopefully going to be there live this year?
Well, we might not be. This year's Notre Dame Tax and Estate Planning Institute is scheduled November 10th and 11th in South Bend, Indiana. And we hope to have it live, but we'll see what happens. I've lined up all the speakers and the topics. This is an example of one of the practical topics that will be available at Notre Dame, which really has nothing to do with saving the estate tax. It's more what has a business purpose. But in any event, over the next several weeks, sometime in June, we might decide to flip it back to virtual again, because we don't want to take the risk of a new variant coming out and have to cancel and switch to virtual at the last minute. But either way, we're going to have the program. All right, so now this is a situation which comes up a lot of times. An individual has a closely held business and none of the children work in the business. And the individual cannot afford to give the business away because they're not extremely wealthy. And so we have a situation where senior has a very successful dental practice, intends to retire sometime in the future, gradually, and also senior wants to pass the business on to the junior dentist, and none of the children are dentists. And they've agreed that the dental practice is worth $1.5 million. And because it's a self-generated asset, senior's income tax basis or cost in the business is zero. And the idea is senior will turn the business over to the junior dentist, but really cannot give the junior dentist the business because senior needs the income in one way or another from the business. And more importantly, senior says, I'm going to continue practicing after I turn over the business to junior, but I'm not going to practice full time. I'm just going to continue partially and eventually, separate from the business entirely. So most people would think, well, the business is worth $1.5 million. So the easiest thing to do would be for, where's the advancement here? I'm looking for it. It disappeared. I can't find it again. Kelsey. Oh, there it is. I got it. So the key to today's presentation is we need to have a planning technique that can accomplish the business, financial objectives, and the tax objectives for what senior intends to do to pass the business on to the key employee who will take over the business. Okay. Now, the problem is that the income, there can be some income tax problems. For example, if senior sells the business to junior for $1.5 million, senior is going to have to pay income taxes on that gain. It'll be a capital gain. And instead of having $1.5 million, senior will end up with the after-tax amount to generate income. So what we're going to try to do is show you how can senior have a rate of return from the entire $1.5 million value of the business and for the rest of senior's life or the life of senior and senior's spouse and never have to report the $1.5 million of gain? So the simple situation is, suppose Junior buys the business outright from Senior immediately for $1.5 million in cash, and he has $1.5 million gain, and the state and federal income taxes on that gain are $375,000. Therefore, Senior would net $1,125,000 after taxes. So Senior would say, that is what I need for retirement, and I'm going to invest $1.25 million at about a 5% rate of return because I can't afford in my retirement to take too many risks. And so I can have a $56,000 annual income on the after-tax proceeds. And what we're going to show you is how can we accomplish all of the objectives, Senior not having to report the gain, and Senior having for the rest of Senior and Senior spouses' lives a 5% rate of return, not on the $1,125,000 after-tax proceeds, but on the entire pre-sale value of $1,500,000. Now, right away, we have a little problem here. If Senior says, I just want the cash, where is Junior going to find the cash to fund the buyout? The key employees that you want to transfer or pass on the operating business do not have the cash resources to come up with the entire $1.5 million up front. So basically, we can say, well, there is a nice solution here. Senior can sell the business to Junior for what is called an installment sale, okay? In other words, instead of Junior having to come up with $1.5 million of cash immediately, Senior can sell the business and take back Junior's promissory note for the entire purchase price. Now, if Senior sells the business and Junior gives Senior a $1.5 million promissory note, that promissory note can pay 5% annual income. And what this means is that Senior can have a rate of return on the pre-sale value rather than the after-tax value. Now, eventually in this situation, this is what's called an installment sale. And the nice thing about an installment sale is very simple. First of all, Senior received a $1.5 million promissory note for a business with a zero cost. So immediately, Senior realized a $1.5 million long-term capital gain. However, under the income tax rules, they're called the installment sale rules, and it's right there in the statute. It's called the installment method. Senior doesn't have to report any of that $1.5 million gain realized on the initial sale until the principal payments on the note are paid. So what this does is give Junior the ability to come up with the cash to pay the principal on the promissory note at a more financially advantageous situation. Now, interestingly enough, Junior is going to still have to pay the interest on the promissory note, but the money that Senior was initially taking out as Senior's own salary stays in the business, and when Junior purchased the business, the money that would otherwise have been paid to Senior as a salary, Junior can use to pay not only the interest on the promissory note, but amortize the principal. There is one little problem with this. Senior will have a $1.5 million promissory note with a zero income tax basis because senior did not report the gain. And if senior dies with that promissory note, there's a special rule that says senior cannot take a step up in basis at death because that was gain that was already realized. And there's a special rule called income in respect of a decedent that says when senior dies, his estate takes the same basis in the promissory note that senior had. So one of the disadvantages to an installment sale is that $1.5 million of gain, even after senior dies. What happened, Alan? Alan, what happened? I lost everything. Okay. I touched something, I'm saying. Where's mine? Okay, I'm back. All right. Okay. All right. So let's go on. All right. All right. So the problem is Junior will have to come up with the $1.5 million at some point in the future. Okay. Now Junior can borrow the money from a bank, but that creates financial problems because the bank will require that the principal and interest on the bank loan be paid regardless of what income Junior is earning from the dental practice. So borrowing from a bank to fund Junior's buyout financially is not the best idea. So now, okay, there are a certain number of other business concerns. After senior transfers ownership of the business on to Junior, senior is going to continue to be compensated for the hours that senior works, and eventually senior is going to wind down the hours and eventually not do anything. But this has to be taken into consideration. This is not a tax concern. This is a business concern, okay? But here's something very important. The business has been very viable because both senior and junior have been generating the income from the business. When senior eventually winds down and permanently withdraws from the business, junior is going to have to figure out how to replace senior as senior gradually retires. And this is a cost, a business concern that needs to be addressed up front. So now let's look at what I have as a solution, okay? First of all, junior does not have any immediate cash to pay senior and really doesn't want the pressure of having a bank loan, which means you got to pay the principal and interest on the bank loan, even though the business may not have a good year and generate sufficient cash. So what we do here is use what's called a preferred partnership. Now, this structure can be used in regardless of how the dental practice or the business is owned. In my example, senior owned the dental practice outright. However, senior could also own the dental practice in the form of a wholly owned S corporation, or it already can be a partnership. So what we're going to do is this structure works regardless of how the business is owned. So what happens is we know that senior's value of the business is $1.5 million. So let's assume that senior's dental practice is owned by an S corporation, that senior owns 100% of the stock. So what happens is senior S corporation will form a partnership, and the S corporation will contribute the value of the business to the partnership for what we call a capital account, which is the $1.5 million value of the business. Now, we want senior's S corporation to be able to get income from the practice. So the preferred partnership interest that the S corporation receives is going to get what is called a priority allocation of profits. And by the way, Junior will become a partner in the partnership without having to make any capital contribution. So Junior's initial capital account, or the equity that Junior contributed to the partnership, is 0. Interestingly enough, there are some very draconian rules in the Internal Revenue Code under Section 2701 that require certain requirements if you have a preferred partnership and the common partner is a related party. But guess what? Junior is not a family member, and therefore all these special rules for preferred partnerships in the Internal Revenue Code do not apply. So how does this preferred partnership work? Well, we're going to give Senior a 6% priority allocation. Now, what does a 6% priority allocation mean? Very simply, I take this preferred interest is the practical equivalent of a bond. It's like I just bought a bond for $1.5 million that pays interest every year at 6% or $90,000 a year. Well, the preferred interest is very similar, but it's a little bit different because with the preferred interest, you don't ever have to amortize principal, whereas with a bond, eventually it has to be paid off. All right. So in this situation, 6% of $1.5 million is $90,000. What this means is that the first $90,000 of the preferred common partnership is allocated to the preferred, and only income in excess of the $90,000 is allocated to the common. Now, the point is, what if the partnership doesn't have up to $90,000 of income? That means Junior will get nothing. Well, Junior was getting a salary already from the dental practice. So what we do is, in the partnership agreement, we give Junior what's called a guaranteed payment, which is the practical equivalent of a salary. And because this is a guaranteed payment that's paid regardless of the income generated by the partnership, it is really a compensatory payment. So the partnership gets a deduction for the guaranteed payment, and Junior reports the guaranteed payment as taxable income. So in this situation, okay, now here is what does the $90,000 represent? Well, remember, Senior was already receiving a salary as the owner of the business. So essentially, the guaranteed payment is the practical equivalent of the salary that Senior was already taking out. So what this means for all practical purposes is it doesn't really require to generate excess cash, because the reduction in the salary that Seniors was receiving is the practical equivalent of increasing partnership profits. Now, so basically, and by the way, in this situation, remember, Senior was thinking of investing the after-tax proceeds at 5%. Well, I just used 6% because the priority return that you're going to give to the preferred interest is a business decision. And in that situation, I said, we can make this even more attractive to Senior because we can give Senior 6% on $1.5 million. And remember that the $90,000 really is a substitute for the salary that Senior was taking out of the business. But Senior is no longer working in the business, so what Senior would have taken out as salary is now available as profits. Now, what's interesting in this situation is Junior now doesn't have to come up with any cash to pay senior the $1.5 million. However, eventually Junior would like to eliminate senior's preferred interest, and the preferred interest gives Junior the flexibility to gradually distribute excess cash from the business to be applied towards the $1.5 million that senior made as a capital contribution. Okay, so in this situation, okay, the financial advantage is Junior can buy out senior's preferred interest only as the cash flow needs of the business increase to or are available to redeem senior's preferred partnership interest. The only problem senior will face is if senior's preferred interest is redeemed while senior is alive and senior has a zero basis in that $1.5 million preferred interest. So let's suppose in year 4 or 5, Junior has $200,000 of excess cash and uses that to redeem senior's $1.5 million preferred account, reducing it to $1,300,000. So therefore, Junior would have to report in that situation a $200,000 capital gain. Now, so basically, this is what's interesting. Senior now has a preferred interest in the partnership, and that preferred interest is not a readily marketable. So right away, even though it entitles senior to a distribution of, or entitles senior to an ownership stake in the business worth $1.5 million, it is not liquid. So it has lack of marketability, and also senior no longer has absolute control over the business. So essentially in this situation, senior could discount the preferred partnership interest, say from $1,500,000, and value it in the gross estate, say at $1,200,000. Well, guess what? No gain was realized when senior converted his ownership stake into a preferred interest. There was no sale. So unlike an installment sale where gain is realized but deferred under the installment method until principal payments on the note are paid, this isn't a sale. This is just converting senior's ownership interest from a regular interest into a preferred interest, and therefore it's entitled to a step up in basis at death. So if they basically senior dies with this preferred interest valued in the gross estate, we can reduce senior's gross estate by the amount of the discount, and his successor in interest to the preferred interest would take an income tax basis in the preferred interest of $1,200,000. However, remember something: if senior is not a multimillionaire and is not going to be exposed to estate tax, remember, after 2025, the amount that will be exempt from estate tax will be $6 million per person, which means $12 million of net worth will not be exposed to estate tax. So no estate tax return is filed, and we don't even have to take discounts and just value it at $1.5 million. Now here's something interesting. Senior says, this is not a very bad investment. I have this nice preferred interest that's generating a 6% rate of return, or $90,000 annually. And where am I going to get that kind of nice conservative rate of return from a business that Junior is running, and I trust Junior to continue running the business? Okay, so what if Senior takes this preferred interest and puts it into a trust for the benefit of trust beneficiaries. Now, $90,000 of income will be taxable each year, but if we kept the $90,000 in this trust, and the trust did not distribute the $90,000, it reaches the very top marginal income tax bracket at $13,000 of taxable income. So why should we keep $90,000 that will be taxable at the highest marginal income tax rates of 37 or of 40% or whatever it is that trusts are subject to? But interestingly, if the trust distributes any of its income to its beneficiaries, in that situation, the income is conduited out to the beneficiaries. In other words, the trust reports $90,000 of income, and if the trust distributes, say, $80,000 to the trust beneficiaries, the trust gets an $80,000 deduction, so its income is only $10,000, and the beneficiaries have to report the $80,000 of income. Well, interestingly, remember, senior is, when senior passes away, senior is going to have children and grandchildren and maybe even great-grandchildren. And these all can be beneficiaries of the trust. So the trust can distribute its income to any one of its beneficiaries who are in lower income tax brackets. And even if the beneficiaries are minor grandchildren, senior can have the trust distribute each year $2,300 of this passive income to each of the grandchildren. And there's something called the kitty tax, which doesn't really apply to the first $2,300 of passive income that a minor child receives. So essentially, if senior has 6 grandchildren, each year the trust can distribute $2,300 of income, almost $19,000 of total, to each of the 6 grandchildren, who will be taxable on the $2,300 at 5%, rather than the trust at 40%, or seniors' children who are now all very successful and are in the highest income tax bracket. Now, the nice thing about this is a disposition of the preferred interest. There is no gain realized because it's still, and you get a step up in basis. But if I wanted to dispose of my preferred interest into a trust as a gift and trust while I'm alive, there's no income to report. So I can basically also give that promissory note to my trust while I'm alive. The only problem is if I give the promissory note to the trust while I'm alive, it's not included in my estate and I don't get a step up in basis at death. Interestingly enough, if senior sold the business to junior for junior's installment note, and senior wanted to gift that promissory note to a trust for the children, there's a special rule in the installment sale rules that says if you dispose of your installment note where the realized gain is being postponed and you dispose of it by gift, all of the gain previously deferred under the installment method is immediately accelerated. So the preferred interest has a lot more planning flexibility than a promissory note under the installment sale. Okay. Now, so here's the question is, do we want to give junior the ability to decide if and when the preferred interest is to be redeemed? Okay. Now, senior might say, wait a minute. Junior can say, I want to redeem my preferred interest while I'm alive. I don't get a step up in basis at death. And remember, the idea behind this is going to be a preferred interest to provide $90,000 a year to senior and senior spouse for the rest of their lives. So they want to take advantage of having this $90,000 of retirement income for the rest of their joint lives and also include it in the gross estate to get an income tax-free basis step up at death to like $1.5 million. So if it's eventually redeemed for $1.5 million, there'll be no gain. So essentially, one of the business concerns in this partnership agreement is basically say that Junior cannot redeem any of the preferred interests while Senior and Senior spouse are alive unless they give permission to Junior. So that is not a bad idea. Now, the other thing is maybe the children say, you know, once mom and dad are gone, you know, I want the cash. So you could put into the partnership agreement that when mom and dad pass away, Junior is required to redeem the preferred interest for $1.5 million. Junior will not have all $1.5 million, but you can require Junior to redeem the interest gradually over, say, a 5 or 6 year period. Okay. In addition, you want to give the flexibility after Senior and Senior spouse die, give the children the flexibility to say, we want to continue receiving the preferred return, or we want to require Junior to redeem the preferred interest. Okay. So these are all business decisions that play a role in deciding how we draft this agreement. Okay. Now, so that very simply is the preferred partnership interest. And it is a very practical approach because what it means is Senior does not have to report any gain. Senior is getting a guaranteed rate of return. And more importantly, Senior is getting the rate of return on the $1,500,000 value of the business instead of the like $1,200,000 after-tax proceeds from the value of the business. So this becomes very attractive. Now, there are some alternatives, and one of them is called an employer stock ownership plan or an ESOP. And my recommendation is for small, closely held businesses that aren't really under over $10 million, we do not recommend ESOPs, okay? Because what is an ESOP? Well, it's very simple. The Senior sets up an ESOP, and we have what's called a ESOP trust. And the key here is, number one, the ESOP trust has to borrow $1.5 million from a bank, and then they give Senior the $1.5 million of cash. Senior invests the $1.5 million of cash in marketable securities and doesn't report any gain. And because Senior doesn't report any gain and had a zero basis in the business, Senior's basis in the marketable securities are also zero. So the problem here is, remember that an ESOP is nothing more than a qualified deferred compensation plan for the employees. And where is the ESOP trust going to get the money to pay Senior $1.5 million? The ESOP trust borrows the money from a bank, which means the ESOP trust now owns the operating business and has to pay back the bank $1.5 million, regardless of how the business is performing. So it puts financial pressure on the business. Secondly, this is not something that the employees can access immediately. It's a qualified retirement plan. So essentially what that means is the employees have a qualified retirement plan and they can't really start to take anything out until they reach age 59 if they want to take it out before retirement. So in this situation, you have the same financial pressures that you have, and the employees can't really access any of the excess earnings in the ESOP trust while they're still working. So they don't have the ability to take the excess profits out immediately until they get to be age 59 and a half. Interestingly enough, this is nothing, the employees will end up having to report any distributions from the retirement plan as taxable income. But here is the real problem. Because this is an employee retirement plan, you must cover a broad cross-section of employees, and you can't limit it to only key employees. So if you have an operating business where you have 3 or 4 people who are really your successors to run the business, and they have a group of like 20 or 30 employees, the ESOP will require you to include in the key employees retirement plan all of the non-key employees. So ESOPs look attractive, but it is financially not an appropriate situation for small businesses under $10 million. Now, so everybody says, oh, the solution is simple. Fund the buyout agreement with life insurance. Because life insurance proceeds are income tax free. So all you have to do is have the business buy a life insurance policy with a $1.5 million death benefit on senior's death. So that means that when senior dies, he gets a step up in basis at death for his $1.5 million interest in the business that senior still owns. And senior's estate gets a step up in basis, the business gets the life insurance proceeds, and therefore senior's estate gets $1.5 million and with no gain to be reported. There are several problems with this. If senior retires and doesn't work in the business after senior retires at age 70 or 75, and he just has an interest in the business that gets in the buyout, the problem is that senior is going to have to report the income in the business that he retains from his share. But basically senior says, you know, I want to retire. I really like this preferred interest, but the life insurance only pays when I die. Well, so what we can do in this situation is very simple, okay? Senior contributes his interest in the business to a partnership, or the S corporation contributes its interest in the operating business to a partnership for a preferred interest, $1.5 million preferred interest with a $90,000 profit allocation, okay? And so that means every year while senior is living, senior and senior spouse can receive $90,000. When senior dies and the trust collects the $1.5 million, senior gets a step up in basis for the preferred interest to $1.5 million. The business collects the $1.5 million death benefit and uses that to redeem senior's preferred interest, okay? The only problem here is the cost of the life insurance. It is an expense that is not deductible. And if you're going to insure somebody age 70 or at this late point in time, the cost of the life insurance premiums will be significantly greater than if senior was 50 or 60 years old. But we typically don't do this until senior is elderly and planning on retirement. So in that situation, you're going to have very large annual premiums to pay by the business, which are not deductible for federal income tax purposes. And the older senior is, senior may have health problems, which will give rise to larger premiums. Using life insurance to fund a buyout, where senior continues to own the preferred interest, is an alternative, but you have to remember there's an expense that is not deductible to fund the buyout with life insurance, and that is you can't take a deduction for the premiums. Okay. With that, I think I finished my slides, and at this point in time, I can take some questions. Alan, do we have any questions here? Hello?
Sorry, Jerry.
Yeah.
Oh, yeah, we have a number of questions.
Good. Well, see, I don't have to run over to take the questions.
Oh, actually, let's see. No, actually, there were no questions.
All right. Well, with that, thank you for inviting me, and I appreciate the opportunity. And again, this is something very practical, even for individuals who don't have a net worth, so they're not exposed to estate tax. And if they're not exposed to estate tax, don't value the business interest as a discount, because you don't get a step up in basis if you reduce the value by the discount.
Jerry, I have a question. Do you use spreadsheets other than what you've shown in these slides that might be available for people to work from to show how you model this out?
I don't have a spreadsheet for this, but I have spreadsheets for other programs like the Charitable Remainder Trust. But, you know, I don't know if you really need a spreadsheet when you just basically say you sell it for cash, you'll have the after-tax proceeds to invest, you take the preferred interest, you'll get a rate of return on the value of the business, not the lower net cash. You get the step up in basis at death, and it also gives you the ability to do estate planning if you want to dispose of it. But we like to say, keep the preferred interest and get the step up in basis at death, so that the gain will never be reported.
Right. Jerry, are there good white papers, articles, Bloomberg portfolios, or anything else? What do you recommend as far as reading in this area?
Well, interestingly enough, there is no article on it directly on point. And one of the things we're doing by today's presentation is it's being transcribed. And that will be my first draft of the article. And I've committed to publish it in Trusts and Estates magazine for their July issue. So it will be forthcoming in July if I get it in by my June 20th deadline. But I have over a whole month to work on the draft and get it up to snuff, and with citations and additional commentary.
So Jerry, you've got a lot of your fans on this webinar, so let me ask you a fan club question. You're doing Notre Dame, you're working on this article. What else are you up to these days?
Well, I'm teaching a summer school course in the Boston University's LL.M program remotely. It's called Business Succession Planning, and it's in the LL.M program. It's designed for LL.M students who have taken all their courses in the LL.M program, and they've seen how all the rules, they've seen all these techniques like GRATs, Cuperts, skins, private annuities, installment sales. And what this course does is take all these techniques and show how they impact and how, and I have spreadsheets that show all the, like you do. Actually, we use a state view, as a matter of fact.
Nice.
Put in a plug for a state view. And what it does is the idea, there's two functions. One is to show the students how the various techniques actually work and their financial impact going forward, so that they can decide which of these techniques or combination of techniques are best suited for a particular client. More importantly, when I use simple to follow numerical examples and simple to follow spreadsheets, it's to teach the students how to communicate a fairly complex estate planning technique in an understandable manner. And what I tell my students is, if you really think you know how to communicate this stuff well, when you visit your grandmother in Boca Raton, Florida, and you can explain it to her and she understands it, then you know you have developed those communication skills that you absolutely need. Now, the other thing that we do is also show you how to integrate the income tax planning and the financial planning into your estate planning. Because in estate planning, you're so narrowly focused on, saving estate taxes and getting step up in basis at death, that they don't consider other situations, like I just mentioned, using non-grantor trust so that you can distribute trust income to beneficiaries who are in lower income tax brackets. For example, what if you have under $80,000 of taxable income and you have a capital gain? What is your federal income tax rate on your capital gain? Zero. Capital gains get a progressive rate table. 0% on the first 80,000 of capital gains, and up to 500,000, it's at 10%. So you have a trust that has an appreciated asset that they're going to sell. You can basically assign that capital gain to beneficiaries who are in lower income tax brackets. And
Nice.
these are the kind of things that we do in the course. It ties everything together in a way that, and it's a review because they've had all the techniques. But what I do in the course is, like when I go over preferred partnerships, I give a little basic lecture on the fundamental partnership principles. But estate view, which is something that Alan's son-in-law developed, right, is a way to illustrate a lot of this.
So Jerry, let me just show you you can see my screen here, right? Just want to show you some new buttons. Now you can click on Look Up AFR and it takes you to the IRS page. So that's nice. You can go to Video Tutorial, takes you to the YouTube page where the video tutorial is. So that's nice. And then when you go to the installment sale calculator, which is here now, once you get your installment sale figured out where you want it, you can click to save results to Excel. And now it has created an Excel spreadsheet that you can then adapt.
Well, Alan, all I know is once I have all this wonderful financial projections, I then have to, like, oh my God, sit down and write a letter to the client, basically describing everything in excruciating detail. Is there any way that you could reduce this letter to maybe a click of the button?
I will show it here. So, yeah, all you have to do here is click Generate Client Letter. And there's your letter. Yep, of all the all the data you put in and all the results.
Not bad. Where'd you get
Yeah,
that
not
idea?
bad. Yeah. It was more expensive than a small boat, but less expensive than a large boat. It was a lot of fun putting this together with you. I appreciate all your help for sure.
And what we did is Alan and I took all the materials that we developed for my classes and his presentations, and we basically focused on installment sales to Grantor Trust. But the most important thing with installment sales to Grantor Trust is the grantor has to pay all the income taxes on trust income. And there's a point in time when the grantor is going to say, enough is enough. It's depleting my estate too much. So it allows you to basically design your installment sale to show the client exactly what the future impact will be, so you can basically educate the client of when you might want to toggle off grantor trust status and stop what we call the burn.
Right. It's been a lot of fun for sure. So Jerry, we do have 2 questions now from your presentation.
Okay.
The first one, what about a $100 million business owner is 60 years old and he has 2 children, 25 employees, making 100,000 a year plus? I'm not sure what the question is.
Well, the situation is, with a business like that, you really don't want to pass on the entire business to the key employees, because it's very profitable and it's going to probably appreciate in value. So what you do in this situation is you want to give the key employees an interest in the business, okay? And you also want to pass the operating business as an income producing asset to your children. Now here's the key. The children aren't going to work in the business. The key employees are going to be operating the business. So what we do, now remember, if the business is owned by an S corporation, the S corporation can form the partnership. It's not that, an S corp is not a obstacle. So what I actually have a article on it that I published for the NYU Tax Institute about 3 or 4 years ago that deals exactly with this situation. In other words, we can give the children a preferred interest in the business, and we can give, in other words, we give the children a preferred interest. And then let's say that you have 100 units of common interest. And so what you can do is, and you want the key employees to stay on and generate future profits. So what you do is you give a portion of the common interest, which has little or no, which has no value because they're not family members, so you don't run afoul of Section 2701. You give the key employees a common interest without them having to make a capital contribution. So if you have like 100 common units, you can basically give the key employees, say, 40 common units and give the children 60 common units. And the key is the preferred interest would take out approximately the amount of the current profits after everybody gets paid the salary. So that is a structure that we actually, I think I'm going to add that as a topic of Notre Dame for this fall, because I hadn't thought about that before. Whoever asked that question, thank you. We're going to add that as a topic. We're going to add that to this presentation. This is going to be a topic at Notre Dame that's going to go into much more depth. Because remember, what you're getting here is a kind of the very first run through. So the key here is you bifurcate the business into preferred and common. give the children all the preferred, and then you split the common between the key employees and the children. So both the children and the key employees can share in the future increased profitability of the business. Not bad. Thank
Okay.
you.
Yeah, then that was from David. Now I got a new one from John. You mentioned that you can assign capital gains from a state to the beneficiaries to get the benefit of the lower tax rate. Can you please explain how this works?
Okay. Let's show the trust. It's a non-grantor trust. Because remember, it has a $1 million appreciated asset with a zero basis. It sells it for a $1 million long-term capital gain. So the trust has to report $1 million of capital gains. If the trust distributes, say, $900,000 of that capital gain, the trust gets a deduction of, wait, I said 1 million, right? Okay, so if the trust distributes $900,000 of its capital gain to its beneficiaries, okay, the beneficiaries report the capital gain. Now, interestingly enough, if the total taxable income of a beneficiary, including the capital gain, is under $80,000, there's no tax on the capital gain. If you're between 80 and 540,000 for a married couple, the tax on the capital gain is 10%. So essentially, if I can just remember, the capital gains rate is a progressive rate. The first 80,000, which is based on your total income. So if I happen to have a bunch of grandchildren who are all in graduate school, and they have very little income, you can distribute like $80,000 of capital gains to them and have it be taxable at 0%.
Wow. Nice. Okay, let me see. There was one more here. Is the ESOP, let me see. When is an ESOP going to be worthwhile in general?
It's worthwhile if the employees understand that this is nothing more than a tax-free qualified retirement and profit sharing plan. Because remember, the ESOP trust takes the income from the operating business and contributes it to the pension plan and gets a deduction. So if the ESOP trust, after the bank loan is paid, if the ESOP trust has operating profits of the business of $100,000, it reports $100,000 in income, puts it into the pension plan, gets a $100,000 deduction, so none of the business profits are taxable. It goes into the qualified retirement plan, and because nothing is paid tax, the employees get the $100,000 plus what it grows to as retirement distributions. So an ESOP, if you want to look at it as a nice way of funding the employee's retirement plan, where the employees, remember, just look at it as a retirement plan substitute, is a very good thing. But remember, the problem is you can't discriminate amongst the lower paid employees, but it's based on their salaries. And if the higher paid employees have salaries greater than the lower paid employees, the cost of funding it for the lower paid employees is not that significant. I don't want to get into ESOPs. I just want to say it's not a great thing for small businesses, because remember, the problem is the ESOP trust has to pay back the bank loan, and that can put a lot of financial pressure on the business.
At least the income it receives it doesn't have to pay tax on, so it could pay the bank loan.
No,
Basically, tax.
No, the income it receives first is used to pay the bank loan. So that means that it's going to have taxable income, so it has to have enough cash to pay the taxes. It's got to retain some of the income.
Okay. Jerry, well, that was a fantastic presentation, and you ended early. That was interesting. You usually go the whole 60 minutes, so I'm gonna have a couple of law students working beginning a week from Monday. So if you want, they can start, taking that transcript and turn it into article if you want any help.
Well, all I want now is first we got to get it transcribed, and then somebody's going to have to fill in all the nice citations of authority. So
Yeah.
we'll get that done. And this will be a paper at Notre Dame, and we're going to add in a $100 million business.
Wow. Okay, well, thanks to everyone who attended this. You helped make a paper at Notre Dame. We should put your name in a footnote.
All
If
right.
you have any other questions, please send them to me or Jerry. If you send them to me, I'll forward them to Jerry. Jerry, thanks for all you do for so many people. My gosh, thousands of tax lawyers. We're all beholden to you for what you've done in the past and what you continue to do. Keep it up.
Well, you know what? My entire practice is actually being a resource for other lawyers. Because they just, in other words, a lot of times a lawyer is thinking about something and wants to talk it through with somebody. And, I can generally be available. And when they call me up, they say, I'm really not familiar. Will you work with me on it? So.
Yeah, you're amazing. That's why we call you so often.
All right. Take care,
All right.
Alan. Enjoy the rest of the day.
Take care, everybody. Bye.